The Committee on Financial Services will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time. If I can just get the attention of my colleagues. We, first and foremost, wanted to have an acknowledgement here today before we got started. We would be remiss if we did not acknowledge the passing of our colleague and friend, Representative David Scott, and obviously represented by the flowers at his spot. I think I can speak for many in the committee that once you got to know David, the layers and depth that was there was impressive. And he and I had actually, had a chance to work on a few pieces of legislation together, but didn't really get to know each other until we sat on an airplane next to each other, flying down to Atlanta as I was doing a rather circuitous route back to Michigan. But I really truly believe that was an opportunity to get a picture into what David was about. And he was a fascinating guy, a very smart man, very experienced man. And for me personally, and I think on behalf of all of us, we'd like to extend our prayers and deepest condolences to his family, his friends, his staff, and frankly, all that had worked alongside of him, both on this committee as well as agriculture and his work there. And in honor of his life and dedication to service, this House, this committee, and to the people of Georgia, I ask that we observe a brief moment of silence. Godspeed, David. A race well run. Hard to transition from that, but we must get back to our business as well. Today's hearing is titled Prioritizing Main Street, Evaluating the Impact of Capital Proposals on Economic Growth and American Communities. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And I will now recognize myself for 4 minutes for an opening statement. Today's hearing will examine the recently released capital proposals from our prudential regulators concerning Basel III, the standard approach, and the GSIB surcharge. That GSIB surcharge has been debated for a long time. In March, the OCC, the FDIC, and the Federal Reserve released revised Basel III regulations aimed at updating U.S. bank capital requirements for the largest banks. These revisions respond to bipartisan and widespread concerns raised about the earlier 2023 proposal, an attempt to refine how capital standards are applied across institutions. They also released a proposal that would make certain adjustments to the standardized approach capital rule, which applies generally to banks. Additionally, the Fed issued a proposal to adjust the capital surcharge application to globally systemically significant banks, or GSIBs. Right-sizing bank regulation is critical to ensure that capital standards are appropriately tailored to risk and do not restrict lending by institutions that play a critical role in supporting our local economies. Capital requirements should promote investment, not compound on one another and impose capital levels well above what actual risk warrants. We must also pay special attention to America's competitive position on the world stage. The 2023 proposal contained requirements that diverge significantly from global standards, placing U.S. financial institutions at a disadvantage. This revised framework takes steps to realign U.S. requirements with international norms. American capital markets are the broadest and deepest in the world, and it's important that bank capital requirements promote their proper functioning. The prior administration's overly punitive proposal would have had significant consequences for bank securities underwriting, hedging, securitization, and equity investments in funds. The revised proposal does more to ensure that banks continue their crucial work as intermediaries that risk flow to those most able to manage them. As we review these proposals, we must ensure they strike the right balance between preserving safety and soundness in our financial system while fostering the kind of economic growth that benefits every American. Committee Republicans have consistently advocated for a capital framework that works not just for regulators or large institutions, but for everyday Americans who depend on access to credit to buy homes, start businesses, and invest in their futures. For example, this revised proposal abandons the punitive mortgage risk weights from the 2023 proposal that drew bipartisan criticism from this committee, helping to protect access to affordable home loans for American families. It is Congress's responsibility to ensure these proposals are clear, appropriately targeted, and do not create unintended consequences that could ripple through our economy. With that, I look forward to hearing from our witnesses today, and I yield back. So I will now recognize the ranking member of the Subcommittee on Financial Institutions, Dr. Foster, for 1 minute for an opening statement.
Thank you, Mr. Chairman, and to our witnesses. And before I get into that, I just wanted to thank you for the recognition of David Scott. You know, he and I had a shared affection for the fireplace in the speaker's lobby and the quiet conversations we had there when all the other members were out smoozing on the floor between votes and stuff are some of the memories that I will carry from this institution with greatest fondness. Now, today our committee is going to examine proposed reforms to bank capital liquidity and stress testing regimes, rules that go to the core of the safety and soundness of our financial system. The prudential regulators have seemingly taken to heart some of the bipartisan concerns that were raised about the 2023 proposals. Certain revisions to the treatment of mortgages, small business lending, tax equity investments, and legitimate risk management activity are all welcome, but they deserve careful review. We simply cannot ask whether these proposals are better than what came before. We must ask whether, when taken together, they will strengthen financial stability, support access to credit, and prepare us for what lies ahead. And that is uncertain, from geopolitical instability to AI-enabled cyber threats to climate-related financial risk, the growing connections between banks and private markets. Regulators must account for all these risks before they become systemic. We must also preserve, not undermine, the ability of prudential regulators and the CFPB to supervise financial institutions effectively. And this includes providing adequate resources and staffing and preserving the independence of the Federal Reserve's monetary policy, which underpins a well-functioning U.S. economy. So thank you, and I yield back.
Gentleman yields back, and I appreciate your recognition of Congressman Scott as well. With that, I recognize the chair of the Subcommittee on Financial Institutions, Mr. Baer, for 1 minute for an opening statement.
Good morning, and thank you to our witnesses for joining us today. Last Congress, this committee devoted significant time encouraging our banking regulators to get bank capital right. We called for a careful assessment of both the costs and benefits of Basel III finalization and a recognition that banks today hold substantially more and higher quality capital than they did 2 decades ago. We were clear that the original 2023 proposal lacked sufficient economic analysis, failed to account for overlapping requirements, and risked unnecessary disruptions to essential bank lending and capital markets activities. It's encouraging to see our banking regulators under the Trump administration address many of these bipartisan concerns and move to a more pro-growth, tailored, and evidence-based approach in their recently released capital proposals. These proposals reduce unnecessary complexity and gold plating that put U.S. banks at a competitive disadvantage. As we evaluate these changes, our goals remain the same: a strong, resilient banking system that supports American homebuyers, small businesses, and farmers. I yield back.
Gentleman yields back. And apparently we have become a construction zone as well. So I don't know if we're going to be enduring that throughout the hearing, or if that's just a temporary situation. But today we have a great panel of five guests who are here. And we welcome the testimony of Mr. Greg Baer, the President and CEO of the Bank Policy Institute. Good to see you, sir. Robert Broeksmit, the President and CEO of the Mortgage Bankers Association. Luigi Ghenghi, partner at Davis, Polk, and Wardwell. Mr. Reggie Griffith, the Global Head of Regulatory Compliance at Lewis Dreyfus Company, here on behalf of the Commodity Markets Council. And Mayra Rodriguez Valladares, the Managing Principal of the MRV Associates. So we thank each one of you for taking the time to be here, and you'll each be recognized for 5 minutes to give an oral presentation of your testimony. And without objection, your written statements will be made part of the record. So with that, Mr. Baer, you are recognized now for 5 minutes for your oral remarks.
Thanks. Vice Chair Huizenga, Congressman Foster, members of the committee, thanks for the chance for being here today. The capital proposals being reviewed by the committee reflect a new and cogent approach to capital regulation. The agencies focus on risk, assess it asset by asset, and show their work. The result will be a capital regime that better reflects risk with substantial benefits to U.S. economic growth. That said, there are significant ways that the proposal undoubtedly overstates capital needs. First, it presumes perfect correlation in losses among credit, market, and operational risk, and simply adds up the capital for each. But in many cases, those risks are not correlated at all. For example, loan losses are not correlated with AML or consumer protection fines that are now the largest cause of operational risk losses. So the same dollar of capital can serve as a cushion against both. Second, while the agencies helpfully acknowledge double counting between the Fed's stress tests and the Basel rules, they have not presented a comprehensive way to reduce it, particularly with respect to market risk. Finally, on credit, some of the Basel risk weights are clearly overstated. For over a decade, large banks reported the results of their internal credit models, providing a robust data set on what an appropriate risk weight should be. That data shows that for a business-rated investment grade by a bank merits a risk weight of approximately 30%, less than half the 65% it would receive in the Basel proposal. The risks for other loans are similarly overstated. My testimony reviews the proposals in great depth, so I will use my remaining time just to debunk a few canards that have arisen about capital regulation. The first is that banks with more capital fare better in a crisis, and thus any increase in capital requirements is a good thing. Certainly, ex post, in crisis, banks with more capital do better. Of course they do. The trillion-dollar question, though, is whether the costs of carrying that capital at all times exceed the benefits. As an analogy, wearing a helmet would be helpful if you fell down or were in a car crash, but we don't wear helmets all day and night because that comes with costs. There is no dispute among regulators or serious academics that higher bank capital requirements reduce the availability and increase the costs of bank lending and intermediation. That's what makes capital regulation hard. A related canard is that banks should be indifferent to capital levels because higher capital improves their credit ratings and reduces their cost of issuing debt. Of course, if this were true, bank investors, analysts, and customers wouldn't much care about higher capital requirements, but of course we know that they care quite a lot. And bank CFOs allocate capital to each business line and adjust the amount of capital when regulatory capital requirements change. That's because capital requirements are a very important cost of doing business in the real world. A third canard is that the failure of Silicon Valley Bank somehow argues for higher capital for all banks. Notably, the banking agencies have never argued this point, even in the 2023 capital proposal. That's because they understand that SVB failed for interest rate risk and depositor concentration. The pending capital proposals are about credit, market, operational, and derivative counterparty risk. The agencies have responded appropriately to SVB by refocusing examination on material risk, updating their liquidity rules, proposing a gradual phase-out of the AOCI filter, and reforming the FDIC's broken resolution and recovery process. A final canard is that banks need more capital because there are rising geopolitical and cyber risks. The Federal Reserve actually runs a stress test which recognizes that banks lose money when unemployment rises, GDP falls, and housing prices fall. It does not matter why those things happen. A war, a virus, technological change, the drivers of loss are the same. And so the Fed properly focuses on the loss drivers and wisely does not try to predict geopolitical or pandemic events and adjust capital accordingly. Furthermore, it is worth noting that capital does not actually protect a bank against a cyber attack or many similar risks, as important as those risks are. It reminds me of a Far Side cartoon with a picture of a horse and a chart entitled Equine Medicine. Two columns show diagnosis and treatment. The diagnoses vary: broken leg, runny nose, fever, ornery, but the treatment was always the same: shoot. For some, the treatment of any bank problem is similarly the same: more capital, ad infinitum. Fortunately, the banking agencies have decided to say nay to that approach and instead use thoughtful analysis to build a capital regime from the ground up. That's it for me. Thanks for your time.
And I appreciate you ending on a dad joke, Mr. Baer, but it does generationally say something with Far Side. So I, too, am a fan, and we'll have to explain Far Side to the youngers in the room. So appreciate that. Mr. Broeksmit, you are now recognized for 5 minutes.
Vice Chairman Huizenga, Ranking Member Sherman, and members of the committee, thank you for this opportunity to testify. I am Bob Broeksmit, President and CEO of the Mortgage Bankers Association and a certified mortgage banker with more than 40 years' experience in the mortgage industry. I want to step back from the technical language of risk weights and instead briefly tell you what these capital rules mean to a family buying or renting a home. First, let me say clearly, the agencies have listened. This new proposal is meaningfully better than the current bank capital framework and the proposed revisions in 2023 that would have caused serious disruption to both residential and commercial real estate markets. Let me focus on 3 areas of the proposal where the details will have real consequences for real people. When a bank originates a mortgage and sells it into the secondary market, it often retains the right to collect payments, the mortgage servicing asset, or MSA. That servicing right has value, and it's a key component of how banks price new loans. In 2013, under the first phase of Basel III, regulators raised the risk weight on MSAs from 100% to 250% with no empirical justification. In practical terms, this took the capital requirement on the value of mortgage servicing from 8 cents on the dollar to 20 cents on the dollar. The result was predictable. Banks looked at that capital cost and walked away from mortgage servicing, with their share of single-family servicing falling from 88% in 2012 to 39% today. That's not a market trend, that's a regulatory outcome. Here's why that matters for borrowers. The value of a servicing right is a direct input into mortgage pricing. When bankers are active and consistent buyers of servicing, that competition drives the value of the MSA, and every increase in servicing value translates directly into lower costs for the borrower at origination. A 25 basis point increase in servicing value is a 25 basis point reduction in closing costs. That's $1,000 in savings on a $400,000 loan. It's not abstract. It goes right back into the borrower's pocket. MBA strongly supports reducing the MSA risk weight back to 100%, and, as the agencies propose, eliminating the cap on MSAs that can be included in Tier 1 capital. Both changes are needed together. Another paramount issue involves warehouse lines of credit, the short-term liquidity that allows independent mortgage banks that originate more than 60% of U.S. home loans to fund loans before selling them. Today, those warehouse lines carry a 100% risk weight. Here's the thing that defies logic. If a mortgage company fails to repay, the bank takes possession of the underlying mortgage note. At that point, the bank holds a whole loan, which carries a 50% risk weight. I'll say that again. Under the current framework, the capital requirement is cut in half if the bank's counterparty defaults. That is the only asset class I'm aware of where the bank is in a better position after its customer fails. That's not a rational risk framework. That's an anomaly that needs to be corrected. The risk weight on warehouse lines should be aligned with the risk weight of the mortgages that collateralize them. The third area I'd like to focus on is the capital treatment of commercial and multifamily mortgages, the loans that build our communities. Banks are essential to this market, accounting for 38% of all commercial and multifamily debt outstanding. And these loans are important to banks, being some of the best performing loans on bank balance sheets in recent decades. Regrettably, high capital charges have kept banks from playing their appropriate role in this market. We support the structure and direction of changes regulators have proposed to address this, including basing the risk weights for commercial mortgages held by the largest banks on the loan-to-value ratio of the loans. Further fine-tuning is needed. We're also urging the agencies to give appropriate capital relief to essential community investment and rental housing tools such as multifamily loans and the low-income housing tax credit investments. The performance of these products has been strong, and capital requirements should reflect that. This proposal gives us a real opportunity to fashion capital requirements that reflect actual risk and provide more affordable mortgage and real estate credit to American families and communities. I'm happy to take your questions.
Gentleman's time has expired. Mr. Ghenghi, you are now recognized for 5 minutes.
Vice Chairman Huizenga, Congressman Foster, and members of the committee, good morning, and thank you for the opportunity to participate in the hearing today. Recognizing that it is impossible in a few minutes to try to summarize the potential impact of 538 pages of rule text and explanatory guidance, I'll limit my observations to making 4 main points. First, in many ways, and especially for credit and counterparty credit risk, the proposed rules are an overdue modernization of the standardized approach to calculating risk-weighted assets in banks' capital ratios, and are intended to make them more accurately reflect the risks of the various exposures. Instead of applying a single risk weight to a category of exposure, such as residential mortgages, they would apply a range of risk weights that depend on factors that measure the relative degree of risk of the exposures. These factors include, for residential mortgages and commercial real estate exposures, loan-to-value ratios, on the basis that as loans are repaid, the amount of loss that a bank can suffer if the borrower defaults also decreases. For credit cards and other retail exposures, borrowers' usage and repayment histories. And for corporate exposures, investment-grade criteria to distinguish between the relative creditworthiness of corporates. Taken together, these changes are intended to make the rules more risk-sensitive compared to the current standardized approach. Lower risk weights for lower risk exposures, higher risk weights for riskier exposures. Second, the 2026 version of the proposed rules compared to the 2023 version, in my view, are better at avoiding add-ons on top of the internationally agreed Basel standards and in tailoring the rules to better fit characteristics of the US banking sector. For example, the proposed rules do not assign higher risk weights than the Basel standards do for residential mortgages and retail exposures, such as credit cards. Third, the proposed changes to the rules for market risk and for operational risk both introduce more overlap between the minimum capital requirements and the stress capital buffer that is added on top of the minimum requirements based on stress testing. For example, both the new market risk rule and the global market shock component of stress testing are intended to estimate market risk losses under stressed economic conditions, not current economic conditions. There is therefore a greater likelihood that banks would have to hold capital twice for the same potential losses. Now, the banking agencies recognize this problem, and the Federal Reserve intends to address it in proposed changes to its stress testing models and assumptions. But it remains to be seen whether that approach, as opposed to recalibrating the minimum risk requirements, would in fact fully address this overlap on an ongoing basis. Fourth, the banking agencies have now performed a more thorough impact and economic analysis of both the proposed rules and the cumulative effect of other finalized or proposed rule changes to the capital or stress testing framework. And they explicitly recognize that there are trade-offs between the level of capital requirements and their impact on the availability and pricing of bank lending and bank trading products, and services. In my view, the ultimate impact of the proposed rules should be measured by two things. One, whether they accurately reflect the various risks to which banks are exposed. And two, whether they allow banks to continue to be competitive in financing and otherwise contributing to U.S. economic activity. Thank you. I look forward to answering your questions.
And a very generous 40 seconds left on your testimony, so duly noted and thank you. With that, Mr. Griffith, you are recognized for 5 minutes.
Chairman, ranking member, and members of the committee, thank you for the opportunity to testify today. My name is Reggie Griffith. I'm the Global Head of Regulatory Compliance at the Louis Dreyfus Company, a global merchant and processor of agricultural commodities. I'm honored to appear before this council on behalf of the Commodity Markets Council. CMC is a leading trade association bringing together ag and energy market participants together with commodity exchanges. CMC advocates for an open and competitive marketplace and supports market-based policy. Louis Dreyfus, like other large ag merchants and processors, commonly called commercials, rely on the futures markets to manage risk. These markets allow commercials to offer fair and competitive pricing to producers and end users, while also serving as key risk management intermediaries. To avoid disruption to this process, the ag sector needs two fundamental elements from the futures market, both of which potentially impacted by the proposed bank capital rules. First, we need liquid, well-functioning futures markets supported by robust risk controls. Second, we need sufficient clearing capacity for the ag sector to manage risk at a reasonable cost. The 2026 capital proposals take a more balanced approach than the 2023 proposals. The 2026 proposals serve both essential requirements and allow the ag sector to continue to use the futures market as it does today. By contrast, the 2023 proposal would have, 1, pushed hedging activity and liquidity away from the cleared model, 2, reduced clearing capacity, and 3, significantly increased the cost of using the futures markets. Collectively, those outcomes would have increased risk and cost throughout the ag sector, leading to less income for producers and higher food prices for the American consumers. Bipartisan efforts to strengthen the risk control since the financial crisis have been a tremendous success. Volume in our markets have drastically increased, and the markets have demonstrated resilience during periods of extreme volatility, leading to the U.S. commodity markets being the global benchmark for all markets globally. The 2026 proposals add safeguards without impairing the markets we depend on. In contrast, the 2023 proposals would have driven liquidity away from regulated, transparent markets back towards less standardized over-the-counter activity. The second critical requirement is ensuring the futures markets maintain sufficient clearing capacity for the ag sector to properly manage risk at a reasonable cost. Commercials serve multiple functions in the ag sector, including providing transparent prices for buying and selling commodities and offering risk management for producers and end users. To access the futures markets, commercials generally must transact through a futures commission merchant. Due to their trading size, large commercials are typically limited to using bank-owned FCMs, most of which are directly affected by the proposed bank capital rules. If bank-owned FCMs are subject to overly burdened capital requirements, the result would be a reduction in clearing capacity and higher costs for clearing services. In some cases, such requirements would drive banks to exit the FCM business altogether, while clearly discouraging new entrants. This would constrain our ability to hold position sizes necessary to properly manage risk and would significantly raise our cost. These impacts would ultimately be felt throughout the ag and food sector. The 2026 proposals support long-term stability of the ag markets while striking an appropriate balance between strengthening safeguards while preserving market liquidity and clearing capacity. On behalf of members of the Commodity Markets Council, I appreciate the opportunity to testify today, and I look forward to answering any questions you guys may have.
We seem to have a contest going on. 51 seconds left in our 5 minutes. So thank you. With that, Ms. Rodriguez Valladares, you are recognized for 5 minutes, or up to 5 minutes, whatever you would choose.
Chair Huizenga, Ranking Member Waters, and distinguished members of the House Committee on Financial Services, thank you for the honor to testify. I am Mayra Rodriguez Valladares, Managing Principal of MRE Associates. Millions of Americans have no lobbyists in this building. They have regulators, legislators, and strong bank rules. Strip those away, and you strip away the protection between ordinary families and the next financial crisis. On March 19th, the agencies released 3 notices of proposed rulemaking that would collectively reduce capital requirements at our nation's largest banks by nearly 5%. Combined with proposed changes to stress tests and the enhanced supplementary leverage ratio, the 8 globally systemically important banks face a 6% reduction in Tier 1 capital requirements. That is $60 billion stripped from the buffers meant to protect ordinary Americans in the next crisis. Capital should be designed to help banks survive unexpected losses so taxpayers do not have to bail them out. The primary justification is that lower capital will mean more lending, especially mortgage lending. This claim does not hold up. Even the president of the Mortgage Bankers Association stated that he didn't expect to see change in who does mortgages. Banks spent 15 years dismantling their mortgage infrastructure. What lower capital will do is fuel trading, increase lending to non-banks such as private credit, dividends, and buybacks. And history is unambiguous. The banks buying the most stock aggressively in 2006, 2007 were the same ones that needed taxpayer rescue in 2008. I ran a stress test calibrated to the 2007-2009 financial crisis. The results are sobering. The reduced buffers could push some of the top 20 U.S. banks dangerously close to the 4.5% minimum. And those stress scenarios do not even include today's added risks, such as geopolitical conflicts, cybersecurity threats, AI exposures, or climate change. Not one argues for loosening bank capital rules. The Federal Reserve's own vice chair for supervision dissented. Not a technicality. It signals a credible internal argument that these changes go too far. Meanwhile, bank regulators have all seen significant staff reductions, eroding the supervisory capacity between Wall Street and Main Street. We are living through elevated geopolitical tensions. GDP now forecasts just 1.2% growth, down from 3.1% 2 months ago. Consumer sentiment is at a 74-year low. Credit card delinquencies are rising. Americans are using pay now, buy later to pay later to buy groceries. Since Basel III and Dodd-Frank were implemented, U.S. banks have grown over 100%. Net income is up nearly 300%, and dividend payouts are at all-time records. Better capitalized banks have lower borrowing costs, and they lend more. There is no quantitative justification for weakening the safeguards on our banking system. My former boss at the New York Fed, Mr. Jerry Corrigan, used to say, banks are special. They are. They are the connective tissue of our entire economy, interconnected to municipalities, pension funds, small businesses, and families. When a bank fails, the harm radiates widely. In the 2007-2009 crisis, unemployment doubled. Those numbers mean destroyed lives, lost homes, and shattered retirements. American depositors, borrowers, and workers are counting on bank regulators and you to protect them. I respectfully urge this committee to act on the following policy recommendations drawn from my written testimony. First, extend the liquidity coverage ratio to Category 4 banks, those that are $100 to $250 billion in assets. These proposals do nothing to close that gap. Second, retain a binding 72.5% output floor on internal risk models. Without it, the largest banks can systematically engineer their way to lower capital. The Basel III standard includes this floor. The U.S. proposal discards it. Third, restrict dividends and buybacks for any banks within 200 basis points of the post-NPR minimum. The proposals release $40 to $70 billion. Additionally, I urge Congress to hold joint oversight hearings before June 18, requiring a single integrated analysis of all three NPR's combined impact and codify liquidity standards for Category 4 banks through targeted amendments to Dodd-Frank. My full testimony contains 12 additional recommendations addressing GSIB surcharge methodology, AOCI, commercial real estate concentration risk, and a mandatory 36-month quantitative review of the final rules. This deregulatory wave will leave the entire financial system more vulnerable, and the Americans most exposed are the ones who had the least to begin with. They are counting on you. Please do not let them down. Thank you.
Gentlelady's time has expired. With that, we'll turn to member questions, and I now recognize myself for 5 minutes for questioning. One of the key changes in the updated Basel framework is the move towards more standardized and in some cases more conservative. I know that may bother some in a description of that, but more conservative and right-sized risk weighting methodologies across asset classes. I think Mr. Ghenghi, you had succinctly put it: lower risk equals lower risk weights, higher risk equals higher risk weights. Mr. Baer, I want to ask you, how do these revised risk weights improve the accuracy of capital allocation across different types of exposures? There's been a claim that more capital actually improves that lending. I think that was one of the things that you had addressed as one of your canards that you had brought out. And I'm curious, how does that translate into safer and more efficient flow of credit to households and businesses?
Sure, thanks. Well, a central feature of the Basel is the new expanded risk-based approach, and that is a more granular look at risk. It differentiates into more risk buckets. So, for example, it considers the loan-to-value ratio on mortgages, which previously was not a consideration. They were all in the same bucket. So by doing that, I think you'll see greater granularity, there's greater accuracy, and more efficient capital allocation. It is interesting that the U.S., unlike other jurisdictions, has chosen not to retain internal ratings-based models, known as the advanced approaches here, where banks modeled that risk subject to examiner oversight. That is an option in Europe, UK, but the U.S. has decided to go all standardized. That said, the U.S. also has a stress test, which other jurisdictions do not, and I believe the regulators are counting on that stress test to provide additional sort of risk capture, because while there are hypothetical scenarios in the stress test, they do actually use bank balance sheets, and so that's probably the most granular and accurate look at a bank's capital position.
So do you expect this to reduce the likelihood of risk being underpriced in certain asset classes, as we saw in the lead up to the financial crisis?
Yeah, clearly. I mean, the central challenge of capital regulation is how detailed you want to get. If it's too detailed, it's basically the government setting the terms of loans, but also it's incredibly burdensome and complicated. On the other hand, you don't want to do what Basel I did, which was just establish a few general risk buckets and treat all corporate loans the same, all mortgage loans the same. I think here the agency struck a good balance where they have a standardized approach that is more risk-focused, more granular, but then they also have in the United States a stress test that'll give you a good look at risks at each bank.
Appreciate that. I'm going to turn to you, Mr. Ghenghi. Looking to minimize the double counting between stress testing and Basel III capital requirements, could you explain how incorporating operational risk that accounts for overlaps with existing stress testing buffers, those stress testing buffers can strengthen the resilience of banks to non-credit shocks, such as fraud, cyber events, system failures, and why that matters for everyday Americans?
Certainly, thank you. Let me first address the overlap or double counting issue. Obviously, that's a problem if you require banks to hold risk, to hold capital twice for the same risks. Under the current rules, operational risk is measured solely under the advanced approaches, not under the standardized approach. These new rules would now require banks to hold capital against operational risk in the standardized approach. The advanced approaches are being removed. Stress testing, though, is measured currently only against the standardized approach capital requirements, not against advanced approaches. So because the current standardized approach has no operational risk component, stress testing provided that additional operational risk component as part of stress testing to require banks to hold capital against operational risks in stressed conditions. But now that the rules are going to be changed and you're going to have an operational risk capital requirement in the standardized approach, if you keep stressing operational risks in the stress testing models without making changes to those risks, you're going to capture the same risk twice.
Okay.
And that means higher pricing, potentially less availability for that service from banks.
All right. Unfortunately, I have about 10 seconds left. Mr. Broeksmit, I was hoping to have a little more time, and I'll follow up a written question. But how important is it that banking organizations have the right incentives to compete to provide mortgage credit?
It's
super quick.
It's the central question because more competition equals more choices for consumers and better execution and pricing.
All right, with that, my time has expired. The chair now recognizes the ranking member of the full committee, Ms. Waters, for 5, I believe, actually first for a point of personal privilege, followed by 5 minutes for questioning.
Thank you very much. Last week, we tragically lost our dear friend and colleague, Representative David Scott. David was a dedicated member of our committee who spent his entire life fighting on behalf of the American people, particularly for working families and underserved communities. And what's maybe not as well known is that he was encouraged to run for office for the first time by Coretta Scott King. And so David was beloved by his district. Every year, he would hold an annual job fair that had countless people in his community find meaningful, purpose-driven work. These fairs would have upward of 6,000 openings. During his tenure on the House Financial Services Committee, David was a leader in advancing policies to expand economic opportunity and to ensure that the American financial system worked well for everyone. As chairman, then ranking member of the House Agricultural Committee, he worked tirelessly on behalf of farmers and working families and rural communities, and to ensure greater equity in our agricultural system. My condolences are with his wife, Alfredia, his daughters, Dana and Marcy, the entire Scott family, his friends, and all those who had the privilege of knowing or serving him. David was a man of compassion, conviction, and unwavering commitment to public service. His passing is a huge loss for our committee and our country, and he will be deeply missed. Thank you, Mr. Chairman. I would like to draw attention to a particular issue, and I'm going to call on you, Ms. Valladares. The Trump administration has been advancing a variety of harmful policies that deregulates Wall Street while making everyday life more expensive for working Americans. First came his erratic illegal tariffs, then efforts to manipulate and undermine the independence of the Federal Reserve. And now we have this reckless deregulation for Wall Street while consumers are suffering through an affordability crisis. Risks are on the rise, including gas prices going through the roof from the war in Iran. New cybersecurity risks emerging connected to artificial intelligence and consumers being defrauded and scammed by bad actors. This administration has took away the financial cops on the beat, including the Consumer Financial Protection Bureau. They have reduced bank supervisory staff and weakened oversight standards by narrowing the risks that can be monitored. Strong capital requirements are the cornerstone and essential to the health and strength of our banking system. So, Ms. Valladares, why should we lower our standards now? Doesn't this push our banking system a number of steps closer to a 2008 global financial crisis?
Thank you, Ranking Member Waters. And thank you very much for enumerating, indeed, the tremendous amount of risks that exist at the moment in elevated oil prices and inflation and geopolitical risks, and of course, the tremendous uncertainty of the tariffs that is really, really impacting American consumers as well as businesses. So this is truly a terrible, terrible time to weaken any kind of bank regulations, especially when it's important to look not just at these three proposed NPRs that do indeed weaken the capital rules, and what the banks are going to do is increase their risk. They're going to trade riskier derivatives, riskier securitizations. They're going to continue to increase their lending to non-banks, which has skyrocketed, especially lending to private equity and to private credit, which are incredibly opaque and very interconnected to the banks. So we should definitely be very concerned about that. Now, when banks complain about burdensome regulation, we have to go back and remember that history matters. It is the banks that did not want the Basel Accord. They didn't want Basel I because they felt that it wasn't risk sensitive enough. And risk sensitivity means then that you're using complex models, and you have to have that lead then to audits and lead to compliance officers and all of that. And so it's impossible to have a regulatory framework that is going to be as simple, right? I keep hearing they want more simplicity, they want less burden, but it's impossible because banks, by their very, very nature, are complex. And everything that the banks do will end up hurting American consumers if they are not well capitalized and sufficiently liquid.
Ms. Valladares, it's something that's bothering me. Have you heard about this buy now, pay later?
Yes, ma'am.
Scheme that is advancing more and more, where people are buying groceries on credit?
Yes, sadly, that is a big problem. Americans are also dipping into their savings, which obviously have been decreasing tremendously. Americans are having to dip into their pensions. So it is and many Americans are not getting paid a living wage. So all of those things have to be considered. They're part of the context.
Well, I'm worried about people dipping into their retirement accounts and what's going to happen to them in later years when they have no money to be able to survive on. This is a crisis that is confronting us, the supportability, and anything that you can offer to help assist us in trying to make the American people understand why it is going on and what we must do. What do you have? Any advice?
Right. Well, number one, do not weaken bank regulations, plain and simple, because banks are interconnected to the entire economy. Number two, make sure that all banks are liquid. What does liquid mean? Simply that you have to have enough cash and cash equivalents to meet your obligations. If American consumers need to be liquid, if we need to pay our debts, then banks also have to be ready to pay their debts at all times. And this isn't about when you wear a helmet and when you don't wear a helmet. The problem is you don't know when the crash is coming. You don't know when there could be a problem with AI or cybersecurity. So that's why capital and liquidity are so critical.
Thank you so very much.
The chair recognizes the chairman of our Task Force on Monetary Policy, Mr. Lucas of Oklahoma.
Thank you, Mr. Chairman, and thank you to our witnesses for being here today. The Basel reproposal we're discussing today is a dramatic improvement from the 2023 proposal, and I laud Vice Chair Bowman's hard work to release it less than a year after assuming a role. This proposal reflects the agreement reached in 2017 by the Basel Committee and rightly reverses the unnecessary and harmful gold plating in the last proposal. As Chair Powell has testified, capital levels are about right. This proposal ensures capital requirements do not reduce our lending capacity, market liquidity, or other market-making activity that banks provide to support the economy. The previous Basel proposal received a record volume of comments expressing concerns over the negative impact it would have had on lending capacity in our banking systems. I'm glad this reproposal was responsive to those widespread concerns and has corrected many of those errors. I hope that we'll continue to see robust engagement during this comment period so that our regulators have a fulsome understanding of the anticipated effects to our financial system. And as additional refinements are suggested, I hope our regulators will be responsive as appropriate. Mr. Baer, I was pleased to see this proposal included some recognition of the risk-reducing benefits of cross-margining. As Chairman Atkins has testified, lower margin requirements through cross-margining are only beneficial if our capital requirements appropriately account for this reduction in portfolio risk. This is especially important in the Treasury market, particularly as the SEC clearing implementation date is swiftly approaching. In fact, the Task Force on Treasury Market Resilience is having a hearing tomorrow on this very topic. In your view, should capital calculations reflect a reduction in risk through hedging activity as adjustments needed to the current proposal?
Yeah, as you noted, it's a significant development that the Treasury market is moving to central clearing. And when it does so, margin requirements or margin demands are going to increase significantly. Thus, cross-margining across treasuries, treasury repo, treasury futures is going to become very important in order to reduce the required margin and make that market function. The SEC has taken actions to allow that from their perspective under their rules, but currently under the bank rules that you don't get credit for that cross-margining. Now, there is some basis risk in those trades, but it is not the case that you are not getting a risk reduction benefit when you are doing netting across those kinds of trades. I just add one other thing. You know, I thought it was helpful that you noted that Chair Powell had said that capital was about right. The committee might want to know, he first said that in 2019. Since 2019, capital has increased 8% for the GSIBs and Category 2 banks, 6% for the Category 3 and 4 banks. So this proposal, which only lowers it 4.8% for Category 1 and 2, 5.2% for 3 and 4, still would have us significantly higher than it was when it was about right.
Fair enough. Mr. Griffith, what does it mean for ag and energy end users if banks reduce their intermediation activity due to an incomplete recognition of hedging practices?
I appreciate the question, and I think this is the biggest concern, for the agriculture and energy industry. The futures market is the key to managing risk, and if we can manage risk appropriately, that can lead to better prices for farmers, better prices for end users, and ultimately better prices for the American consumer. However, if we cannot deploy the risk we need to properly manage our businesses, that's going to inject risk into the system, it's going to inject cost into the system, and that's going to lead to less money for farmers, it's going to lead to higher prices for the American consumer, and as I think from an unnecessary standpoint, inject risk throughout the entire food chain.
Continuing with you, Mr. Baer, do you anticipate additional comments on the GSIB surcharge calculation in this proposal, and what adjustments would you like to see the regulators consider?
Well, the major adjustment that's necessary, when the Fed adopted it in 2015, they did so with fixed coefficients and using data from 2012 and 2013 in terms of the size of the economy. They acknowledged at the time, as the economy grows, the GSIBs are going to grow along with it. That doesn't make them any more systemically important. They are still relative to the economy the same. The proposal oddly says, okay, we are going to adjust, as we promised in 2015, for economic growth, but only back towards 2019. That adjustment, if they are true to their word and principle and logic, would go all the way back to 2012, 2013.
Thank you, Mr. Chairman. I yield back.
Gentleman yields. Chair recognizes the ranking member of Subcommittee on Capital Markets, Mr. Sherman of California.
Pay is too low, prices are too high, and people need to borrow money just to make ends meet, whether it be on the credit card or these new buy now, pay later programs. If our regulation is too tough on banks, that shrinks the economy. If it's too loose, we get 2008. We need to do the hard work of configuring these regulations in a way that is logical and focuses on real risks. The Basel III proposal has gotten better in a number of respects. I think most important is a recognition of the need to mark-to-market losses on held for sale securities. If this had been done, we wouldn't have had Silicon Valley Bank. Another improvement, and I enjoyed working with Mr. Kasten on this, is fair treatment of clean energy tax credits. I'll talk later about mortgages. When it comes to commercial loans, the original proposal discriminated in favor of companies that were publicly held and giant companies. That has been ameliorated. And as ranking member on capital markets, I'm pleased to see that capital market trading activities are no longer being penalized by these rules. Now, Mr. Ghenghi, I hope I'm pronouncing that right. I think you were right to bring to our attention this possibility that there were probably a situation where they're double counting the counterparty risk. We want banks to hedge their risks. They do so by acquiring derivatives. There is, of course, the risk that the counterparty will not come through. But the current draft seems to double count that. I'll point out that Silicon Valley Bank did hedge their risks and then unhedged, sold their hedges at a profit. So we'd like them to hedge their risks and keep and not undo it. I commend you for addressing our attention to the need to make sure that we're not counting the risk and then counting the market, noticing that the risk exists. That's double counting. One concern I have, Mr. Broeksmit, is the private mortgage insurance. People need private mortgage insurance when they can't come up with a 20% down payment, which is every young couple I know. And it's my understanding that these proposed rules don't give the bank credit for the fact that there's private mortgage insurance. Do I have that right?
Yes, you do. The rule does ask what the appropriate treatment of private mortgage insurance should be, and of course, we will say that it's loss-absorbing capital before the bank, and it should be given credit when you look at the risk weights by loan-to-value ratio.
Otherwise, a bank might buy a mortgage without private mortgage insurance and be treated as if it was the same risk, same mortgage with private mortgage insurance. As I said, we want banks to hedge their risks, and one way to hedge the risk is to have private mortgage insurance. We've got, through the mortgage process, you need the warehouse line of credit for 10 or 20 days while the package is put together and sold on the market. Mr. Broeksmit, could you explain how this works and how these proposed rules will unduly penalize those who are playing that critical role, those 20 days between when I get the money from my house and when investors buy that mortgage in the market?
Yes, as I mentioned in my oral testimony, the risk weight for warehouse lenders is 100%. If the counterparty fails, the warehouse lender seizes the note, now owns a whole loan, and it's a 50% risk weight. It drops in half if the counterparty fails. This does not make sense, and the risk weight for warehouse lending should be the same as the underlying asset that collateralizes the loan. This provides liquidity and stability through all economic phases, and we want banks to continue to participate in this important activity.
Thank you. I look forward to us dealing with also the internal modeling approach that Silicon Valley took, which was manipulated, and making sure that we don't have a manipulation of internal bank models to hide their risk, and I yield back.
Gentleman yields. Chair recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. You pay attention to the market. You pay attention to the daily turns of our country, of the world. You look at things and come and help us to put a fine point on them. And I'm delighted that you are here today. Some believe that we are going through, on any given 2 or 3 week period, changes that might have taken place in a decade. And it means that you do have to pay attention. You do have to weigh risk. I'm delighted to hear each of you, except for perhaps one, say that the stress test equals the risk, and that means that you have the ability to pay attention. But I would also say that as I sat here listening, I looked, and as of April 28th, 2026, the average 30-year fixed mortgage rates are holding around 6.12 to 6.34, while the 15-year rates are generally 5.3 to 5.6. When I graduated from college, it was 18%. We had Jimmy Carter in office. Jobs were not available. I also checked the number of open jobs in this country. I had to haul hay for a bit and work in an industry where we made housing. And the bottom line is there's about 7 million open jobs seeking people at this time. And if you just listen to some of the things that are said up here, you hear fear and you hear anxiety and you hear how that it's not working. The bottom line is, I think each of you, by and large, have said the American dream is working. It's working at a time when the country moves dramatically forward. It moves forward in healthcare. As a matter of fact, we saw directly this last month where healthcare jobs, the opportunity to greet people, the opportunity to have technology, moving America forward is working. This is the American dream. And I want you to know, to sit through this and hear about the processes that you're talking about, knowing that you do believe that risk is captured by the stress test that this administration regularly poses, that the opportunity to speak with each of you about the capital requirements of where that balance is really helpful. So, Mr. Chairman, I have fewer real questions than I do to say I'm listening to the aggregate of what you're saying. I go back home to Texas every weekend and I listen to employers. I listen to workers. I was delighted to hear that most of you talked about the relationship to agriculture, prices, commodities, the things that really do also matter to every one of us, whether you have a job or don't have a job, whether you're working or whether you are living in a way where you're retired. We do have to focus on these. I would ask each of you, think about the agriculture and food sector. Does anyone have additional ideas about the stability of that marketplace in adding in what we're talking about today? Yes, sir.
I do, and I think you talked about it earlier. I mean, the markets are working, and specifically the futures market, which is really where the ag sector manages its risk. I mean, after Dodd-Frank, everyone worked together to put extremely robust controls in place that have stood up to times of extreme volatility. And so as we look forward, it's been tested over and over and it works, so we need to be very cautious of putting overly burdensome controls in place that are only going to lead to, I think unnecessary, consequences up and down the ag sector. I mean, when you put overly burdensome controls, you're going to lead to, more cost in the system. You're going to lead to less money for farmers, and you're clearly going to lead to, higher prices to the American consumer. So every time you look at more controls, you need to look at the negative downside. And specifically, when you look at the ag sector, you need to look at the futures market, and it works well. So we don't need to go overly overboard, on additional controls, because I think there are a lot of unintended consequences that people aren't looking for.
Mr. Chairman, thank you. Mr. Chairman, thank you for having this meeting today. The American dream works, our systems are working, and we have jobs that are available for people. Thank you very much. I appreciate each of you taking time to be this.
Thank you.
Mr. Chairman, I yield back my.
The gentleman yields. The chair recognizes the ranking member of the House Foreign Affairs Committee, Mr. Meeks of New York, for 5 minutes.
Thank you, Mr. Chairman. As a member of Congress and as a New Yorker representing the financial capital of the world, I lived through the 2008 financial crisis, and I saw what happens when our financial system fails. Families losing their homes, businesses shutting down, communities across the country paying the price. That experience is a reminder that maintaining the safety and soundness of our financial institutions is in everyone's best interest. And at the end of the day, this is about getting that balance right. It's about making sure we maintain stability and safety while also allowing access to affordable credit and mortgages, especially for communities that too often have been left behind. When the original Basel III proposal came out a few years ago, my colleagues and I were concerned with the unintended impact of the proposed changes. So we sent letters to the regulators raising concerns that certain parts of that proposal could drive up mortgage costs, especially for borrowers with smaller down payments, or that it could potentially widen the racial homeownership gap or discourage lending to CDFIs and MDIs. So it's my belief that the economic mobility and the safety and soundness of our financial institutions and banks must be at the center of everything that we do in this committee. So I asked Mr. Broeksmit, can you walk me through how the updated Basel III proposal addresses those same concerns we raised on mortgage affordability and access to credit, especially for underserved communities?
Thank you, Mr. Meeks. I echo your concerns with the previous proposal, the 2023 proposal, about which I also testified in front of this body. And I'm happy to say that the agencies have listened and removed what we referred to as the gold plating in the capital requirements for loans on banks' balance sheets. For some reason, they chose to go 20 percentage points above the Basel numbers, which would have made it prohibitively capital expensive for banks to make loans to people with a low down payment who, as you mentioned, are often people who have been underserved in the past, minority borrowers, low and moderate income borrowers, first-time home buyers. So this proposal eliminates that, and it gradates the capital required by the loan-to-value ratio. I mentioned before that private mortgage insurance needs to be included in the mix so that those loans to people with less than a 20% down payment can still be made by banks.
Thank you for that. Let me just ask Mr. Baer, with banks holding less capital under this proposal, how confident are you that this will translate into increased lending for CDFIs and MDIs and strengthen community reinvestment?
Sure. I mean, they will be holding less capital, but as I noted before, they'll still be holding significantly more capital than they were holding as of 5 years ago. We believe there's significant room for capital relief here that the agencies have provided. And again, it is absolutely clear, and somebody who worked at a bank, I know the job of the CFO is to assign capital out to each line of business. And if the cost of that capital goes up because the regulatory requirements go up, the allocation is going to go down and there's going to be less of it. That's true across all products. Completely separate from your concern, but today there was a report in the Financial Times that it was a result of a reduction in the enhanced supplementary leverage ratio, which basically penalizes holding low-risk assets like Treasury. Since that change was made, bank-affiliated broker-dealers have added $150 billion in Treasury inventory. Now, some would say, oh, that wouldn't have mattered, and some did say that, but it matters. It matters whether it's CDFI lending or securities trading.
Thank you. And, I just have to ask Ms. Valladares, I'm the ranking member in the House Foreign Affairs Committee, and I spent a lot of time working with our partners around the world. And now, as the world's largest economy with the deepest and most important financial markets, is it not in the United States' interest to adhere to international standards like the Basel framework? And if we didn't have a coordinated international framework, what would that mean for the stability of the global financial system? And would that not be a race to the bottom?
Thank you, Mr. Meeks, and thank you for serving New York, where I live. This idea of gold plating has been exaggerated. Our banks are indeed the best. They are it's precisely because of regulations, because they are well capitalized, they are liquid, and their misdeeds have cost them $250 billion. All those fines would be so much better used if banks had serious operational risk management and weren't involved in mortgage fraud and so many other misdeeds. This deregulation, which is what this is, this wave of deregulation is a big problem. And by not adhering to Basel III standards—
Gentleman's time has expired.
Mr. Chairman, I have a unanimous consent request to into the record several statements from experts and stakeholders,
Without
including
objection.
sheet from Better Markets entitled, "The Main Street Economy Will Suffer If Capital is Reduced for Wall Street's 8 Mega Banks," a punchbowl interview with former FDIC Chair Sheila Baer, where she said, "Why are they reducing capital?" and testimony last December from Nobel laureate and former IMF chief economist Simon Johnson.
Without objection. The chair now recognizes the chair of our Subcommittee on Capital Markets, Mrs. Wagner of Missouri.
I thank the chairman, and I thank our witnesses. Last year, Ranking Member Sherman and I sent a letter to the prudential regulators asking them to carefully consider the implications of the securitization framework while deliberating a new Basel III Endgame proposal. The original 2023 Basel III proposal would have had drastic consequences on securitization, which plays a vital role in helping banks manage their balance sheets and making credit, most importantly, credit more affordable and available to constituents who need it to finance a home purchase or perhaps a business. The capital benefits of securitization depend on carefully calibrating several parameters, including something called the P factor, which determines the additional capital required for a pool of securitized assets. Under the previous proposal, this P factor would have doubled, greatly increasing borrowing costs for consumers and reducing the availability of credit for millions of Americans. Mr. Ghenghi, how does this new Basel, the new one, proposal strike a balance between safety and soundness while preserving the role of securitization in our economy?
Thank you for your question. So what this proposal does is it borrows from a couple of elements of the Basel framework. The Basel framework actually has a simplified securitization framework where that P factor stays at 0.5, and where the risk floor, the minimum risk floor for securitizations goes down to 10%. Now, the 2023 proposal did not adopt that framework, took the P factor, doubled it to 1, and then set the minimum floor at 20%. What this proposal does is it's a hybrid solution. It takes the 0.5 P factor from the simplified Basel framework and keeps that in place for all securitizations in the United States. And then, consistent with the Basel framework, takes a 20% minimum risk factor floor to all securitizations. They don't go down as far as 10%. Sorry, they reduce it to 15%.
15.
They reduce it to 15%.
Mr. Broeksmit, for too many Americans, the prospect of owning a home seems out of reach. While supply remains a key issue, the availability of affordable mortgages has also played a role. Many banks and financial institutions that have long been lenders in the mortgage market have pulled out, and especially in urban and largely suburban districts like my own. This can lead to less competition and fewer options for home buyers. In your opinion, if the prudential regulators get these rules right, could we see new entrants and more competition from banks in our mortgage markets? What potential positive effects could first-time home buyers see in places like my hometown of St. Louis?
Sure. Well, I certainly think that getting the capital rules right for loans held on bank balance sheets will encourage them to make more of them, and that's really the start. And the other thing that is very encouraging is President Trump's executive order on mortgage affordability. There are all sorts of good ideas that the regulatory bodies can do to wring cost out of the system and make mortgages more available. We also think that Fannie Mae and Freddie Mac have a role to play here. They have something called loan level price adjustments, which we think could be reduced to make mortgages more affordable for everyday Americans.
Thank you. And Mr. Baer, while the most direct impacts of the new Basel III Endgame proposal will be felt by the globally systemically important banks, or GSIBs, and other large financial institutions, every change in regulation of this scale and magnitude is likely to have a variety of impacts downstream, including on regional and smaller community banks who often have the closest banking relationships with constituents in districts like mine. How do you think changes to the capital requirements and risk weights for larger banks will help the broader financial ecosystem, including regional and Missouri and community banks that serve Missouri's 2nd District?
Yeah, I mean, the regulators have been very careful, Hill, to ensure that banks of all sizes will see capital relief and rationalization. They've recently lowered the community bank leverage ratio from 9% to 8%. Regional banks will have a standardized approach that is somewhat of a discount to current, but also the opportunity to opt into the same regime that the largest banks.
My time's expired. I'd ask you to add any other additional comments in writing. Thank you. I yield back.
The gentlelady yields back. The ranking member of our subcommittee on digital assets, Mr. Lynch, is recognized.
Thank you, Mr. Chairman. I want to thank the witnesses for your testimony this morning. Very helpful. The collapse of Silicon Valley Bank a few years ago, which actually lost $42 billion in a single day. That was unbelievable. And also the collapse of Signature Bank and Republic Bank were largely precipitated by very, very poor risk or no risk management, which allowed the concentration of large uninsured deposits that far exceeded the FDIC cap of $250,000 per account. Those deposits were held by a narrow class of depositors, including venture capital firms, some fintech firms, and a couple of crypto-related firms like Circle, which is a large stable coin institution, financial institution. The only reason this was a very troubling time for the members on this committee watching what was going on in the banking industry. The only reason that we did not have a systemic spread of that collapse was that the Federal Reserve Bank, Treasury, FDIC got together. It was a Sunday night. I remember it distinctly. And they basically came out with a statement that they were going to make everybody whole, even the uninsured depositors. And that calmed the markets. But if they had not done that emergency session that night, Sunday night, when the banks opened on Monday morning, there would have been hell to pay. We would have had a major disaster on our hands. It would have spread across the banking industry. And it affected basically a bailout, what it was, because what we did was we rescued the uninsured people by requiring the taxpayer to step in on their behalf. So that the banks that were doing the right thing and depositors and taxpayers, we basically picked up the tab. So we covered the risks of those risk takers. The Fed bailed out those banks and also arranged a friendly takeover by, I know in particular, J.P. Morgan Chase stepped in and became even bigger. Now we have, and Ms. Rodriguez-Valladares, I'd like you to address this because you've got a great, I really appreciate your testimony, very lengthy. I know you weren't able to talk about all of it in your oral testimony, but now we've got these 3 NPRs, these Notice of Proposed Rulemakings. And one of them is talking about lowering the capital reserves. Another one is $60 billion that they're lowering, the buffer that would normally protect banks that were in that difficult situation. We want to lower the rigor of our stress tests, and we want to, and we have also, in the meantime, we've passed the Genius Act, which allows banks basically to be in the same position that Silicon Valley Bank. It allows banks like Silicon Valley Bank to hold uninsured deposits as a reserve for these stablecoin issuers like Circle. So we've continued to erode, and these proposals want to erode the protections that we have. What are the risks? You talk about them in your paper. What are the risks to taxpayers, the risks to depositors, the risks to the banking community, and the banking system at large, created by these suggestions?
I mean, the biggest risk, of course, is that banks the size of SVB or even larger would fail. And in fact, it's the regional banks that could have way more trouble than the GSIBs because they are way more concentrated both on the asset side and the liability side. And plain and simple, when banks fail, it destabilizes the rest of the financial system, and it means that the Fed, FDIC, OCC, everybody has to run around on that weekend precisely to solve everything on a Sunday. And they're already, the resources that these agencies have are way less than they have been. We have to keep that in mind. We still need these people, and there's fewer of them. A lot of talent is left. So that means that if we have a crisis now, it would be much harder. And in my analysis and my stress test, when you apply those GFC scenarios, many of the banks would barely be at a minimum. And many of the Congress people who've now left the room have talked about agriculture. And that sector, the best thing you can do to help that sector, my father was a potato and mint farmer in Indiana where I was born, and I lived in Texas, so that sector means a lot to me personally. But the best thing you can do for those farmers is help them make a living wage and keep banks from failing. If banks fail, those farmers are going to get hurt.
The gentleman's time has expired.
Thank you. I yield back. I thank the gentlelady. Thank you.
Gentlemen, thank you. The gentleman's time has expired. I now recognize myself for 5 minutes, and at the outset, I'd like to submit for the record a letter submitted by SIFMA evaluating the impact of capital proposals without objection. That will be submitted for the record. So Ms. Valladares today has repeated an argument that I recall former Vice Chair Michael Baer making during the 2023 proposal. Mr. Baer, I'll have you comment on this. The argument goes something like this. Higher capital requirements lead to higher credit ratings for banks, which help lower borrowing costs for banks, which in turn allows them to pass on those lower costs to American consumers in the form of more lending and lower cost of credit. This seems pretty counterintuitive, given that higher capital requirements constrain the ability of banks to deploy capital into the real economy. Can you address this argument?
Sure. It is clearly the case that to the extent a bank has more capital, its credit ratings will go up, and it should be able to borrow marginally less cheaply. So that is a benefit. On the other hand, there is a cost, and the most expensive way for a bank or any other company, for that matter, to fund itself is through equity. And that is why most companies try to diminish the amount of equity that they have to hold. Again, as someone who's worked inside a bank, the CFO, the corporate folks, they know how much equity costs. They know their cost of capital. And they monitor it, and they mete it out to the lines of business that can earn the highest return on that equity. They do not ignore the cost of equity. And of course, if you read any analyst report, talk to any investor, they're all very focused on this proposal. Under that analysis, they would be completely indifferent because the increase in cost for equity would be matched by a decrease in cost for debt. But everybody operating in the markets, all people who invest in banks, know that's not the case.
Mr. Ghenghi, I'll have you also address that argument. And how does the revised framework ensure that higher capital requirements do not unnecessarily constrain lending to creditworthy borrowers?
Well, I think they do so by becoming more risk sensitive in calculating the risk-adjusted amount of bank exposures. I mean, one of the things I would note is that under the new rules, risk weights do not just go down, they also go up. So there's more risk sensitivity. If capital requirements in the aggregate go down, it's probably because banks' exposures are concentrated at the lower risk end of the scale. If banks' exposures were concentrated at the higher risk end of the scale, then capital requirements would go up under the new proposals. So I do think they are more risk sensitive and therefore allow a more risk sensitive pricing and availability of services.
But just going back to the 2023 proposal, is it fair to say that this argument that the higher capital requirements would have led to more lending, is that a debatable point?
I think it's debatable based on my experience as a lawyer advising banks. Banks pay careful attention to the risk-weighted asset impact of any asset class, and they have a hurdle rate, an internal hurdle rate. And if an exposure doesn't meet that internal hurdle rate, they will change the pricing or change the availability.
And I think a lot of the economic analysis on the 23 proposal was that, in fact, lending would go down substantially, materially. Let me go to this gold plating argument. Back to you, Mr. Baer. Mrs. Valladares makes this argument that more regulation actually enhances the reputation of American banks, and therefore American banks become more competitive with gold plating. Do you disagree with that? And why is, and do you think that the most recent proposal on Basel III finalization moves us away from gold plating?
It is true that one reason U.S. banks have done well is that they and the regulators in the immediate aftermath of the global financial crisis were quicker to rebuild capital than those in Europe and other places. So that is certainly true. But around the gold plating, I mean, the fact is the current proposal is closer to Basel norms than the 2023. The 2023 proposal just spuriously added capital requirements to Basel. So here, whether it's the risk weights around consumer, mortgage, the securities listing requirement that I believe Congressman Sherman mentioned, we are now more in line with the EU and UK adoption of that proposal. Well, the remaining big gold plating really is in the stress test, and as I think Luigi mentioned, with regard to op risk, it's a double count, and certainly with regard to market risk.
Well, that corroborates what the Basel Committee actually told a bipartisan delegation that traveled to Basel, was that the 2023 proposals actually moved away from Basel III proposal because it was excessive relative to what the international standards were. My time has expired. The chair now recognizes the ranking member of our subcommittee on housing and insurance, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. I want to follow up on what the ranking member said earlier, and I sat here and observed what was going on because almost all of the people since the ranking member spoke are men and women who were in this very room, as I think Mr. Meeks suggested, when we were informed about what was happening in the markets and in the banks in particular. And I can remember, when I look back over the months before the 2008 collapse, we had people coming in here telling us everything was great, everything, including the credit rating agencies. And we didn't even catch on when the first bank went down. Contrary to what many people say, the first bank to collapse was Douglas State Bank in Kansas City. It actually collapsed in January. And then we don't generally look at Lehman Brothers on the 15th of September. And then, of course, as all of us will remember, there were 25 bank failures. And it just threw a wrench into everybody's life, but poor people in particular. And so you could understand, at least I hope, that we went through this. Bear Stearns, it was a bad experience. And so as I'm sitting here listening and also thinking about this discussion, Santayana, I think, is the one who made the statement about remember the past or you're condemned to repeat it. And this discussion, brings me back to that point, especially when I look at the non-bank mortgage lenders, which originates more than 50% right now of home loans, and they service the overwhelming majority of federally backed mortgages right now. And my concern is we have essentially, stripped the CFPB of its authority. It is a weakened agency. But one of their roles was to enforce consumer protection laws that regulated financial products and services, including mortgages. Ms. Valladares, do you believe that there are risks now as a result of the fact that we have essentially eliminated the CFPB?
Yes, very significant risks. I mean, when you don't have the same level of talent and brain pool at the CFPB, so many people gone, and the same problem to a lesser extent, but nonetheless, a lot of staff has left the Fed, the FDIC, so you have fewer people keeping their eye on the many, many risks that banks take, and banks will take more risks when you deregulate, when you decrease their capital. They are not, ladies and gentlemen, they are not all of a sudden going to be lending to mortgage borrowers. They are not going to be lending to the farmers in South Texas where I grew up, or in Indiana where I'm from, as I said. That's not what they're going to do. They're going to increase their lending to private credit, to private equity, to other kinds of non-depository financial institutions. They take more risks. I worked at JP Morgan in the emerging markets as a Russian analyst. I work with these traders. I know exactly what they're like. They take risks. They thrive on that. That's great. It makes great profits for JP Morgan, but it doesn't help the American people. When those banks fail, it's the regular people who have nothing to do with the party on Wall Street. They're the ones that end up paying, and that's why I'm here. And it's too bad that the congressman from Texas was talking about the American dream. Absolutely, the American dream is alive and well. I'm a product of that. But I want to make sure that other people also have the American dream. And so if you let banks fail and those people lose their jobs,
Time has expired.
those banks are not going to come help them.
Thank you. Thank you.
The chair now recognizes the chair of our subcommittee on national security, Mr. Davidson, for 5 minutes.
Thank you, Chairwoman. Thank you for our witnesses. Appreciate your work in this space. The safety and soundness of our financial system is paramount to America's strength. You know, with less than 5% of the world's population, we got over 50% of the invested capital. The banking sector makes a lot of that possible, and the reserve currency status certainly helps us a lot. But when you look at all these things, we keep looking at the Europeans. Most of Americans don't know there's a place called Basel, Switzerland, and somehow Basel seems to exert all this impact. I felt it as a small business guy not long after Dodd-Frank passed, and they started stress testing the G-SIBs, and I had a G-SIB as a bank, a couple hundred employees in a manufacturing company, and my banker comes to me and says, you know, did you ever think about growing more slowly and playing more golf? I'm like, not really. Why would you want me to do that? It seems like it's working pretty well for you guys. And basically explain how they were going to treat lines of credit as if you're using all of it. This is stuff they come up with in meeting rooms and solving problems that aren't really problems. You know, our company was strong, but it was in manufacturing. And today you have the same sort of scared capital. I agree with the lady who's talking about, yeah, they're fine flooding private credit that are buying up all these companies, putting stress on our small and mid-market firms, but the lenders and capital aren't going there. And when you look, one of the dynamics around the time that the financial crisis was going on in 08, 09, the Federal Reserve started paying direct payments of interest to banks for required reserves. And they said, you know, it'd actually be easier to monetize all this if we just paid you interest on all your reserves. So in light of that, you know, do we even need capital requirements? They seem to be hoarding lots of cash there. They're getting a 4% rake with zero risk, zero management of their own treasury. So Mr. Baer is a Bank Policy Institute guy. What lets banks do their thing? Because right now, with all these dynamics, we see a lot of non-bank lenders. So clearly the banks aren't meeting the market need. And Basel's approach is to make it harder to meet the need. What's the future like?
Well, actually, quite relevant to your prior experience. One of our concerns about the proposal is that it's actually requiring the capitalization of unconditionally cancelable commitments. This isn't like a credit card line or a HELOC where the customer can draw at any time. These are lines where the bank has to reapprove and can cancel. It was phrased as a clarification in the proposal, but it's a major substantive change that would affect businesses like your old one. So, it's an unbelievably complicated proposal. There are a lot of these little things in there. That's why it's hundreds of pages long, and I don't even want to know how long our comment letter is going to be. But it's really important as we look to the ability of businesses to thrive that we make sure we get all these risk weights right.
Yeah, thank you. And, it's safe to say I don't think they've got the right approach right now. Mr. Griffith, what other things are we confronting in this, Basel-imposed, mandate on our own country that frankly is crushing Europe in terms of performance? Why would we take our guidance from them?
I agree. I mean, we clearly, I think, since Dodd-Frank have done a fantastic job. I mean, it wasn't perfect, but I think it's put us in a place where we are the benchmark for all, futures exchanges globally. And I think we need to look at our own needs and our own requirements here and make sure we continue to stay the course and continue to become the gold standard as we move forward. So I would agree with you 100%. We need to look at our own needs and not necessarily trying to mimic, other regimes which clearly have not done the job we have, at least in regard to the futures markets.
Yeah, thank you for that. Look, I think there are so many layers here, but, our community banks, for example, generally aren't too big to fail, and we've undermined those, and we've shrunk the community bank sector by a lot with a lot of this heavy-handed regulation. I think that's made it hard to meet the addressable needs of the marketplace. So I hope we re-embrace tailoring and re-embrace some of the things that have made banks responsive to market needs. I am highly concerned that private credit's really signaled that banking hasn't met the market need, and we haven't really captured some of the risk there. Anyone care to weigh in the last few seconds about paying interest on bank reserves, including excess reserves? Is that good policy or not?
Yeah, we've written a fair amount on this. Paying interest on reserves is no different from paying interest on a treasury bond. If you hold a treasury bond, you should get interest. If you hold reserves, you should get interest. It's also extremely important for the efficacy of monetary policy. So while it may not be popular, it is certainly necessary.
Yeah, thank you. I yield.
Gentleman's time has expired. With that, the gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chair and Ranking Member. Thank you for this hearing. Again, I want to thank all the witnesses here today. Mr. Baer, you gave us a rather provocative analogy of the helmet. You said that you didn't specify, I don't think, if it was a motorcycle helmet or what kind of helmet, but if you wear the helmet all the time, that in fact, you would be safer because in case you fell, you'd be safe because you had the helmet on. Of course, you could have taken the analogy the other way and said, well, actually, when you're riding the motorcycle, you don't have to wear the helmet all the time, only when you're going to crash. Only when you crash, because otherwise you're wearing the helmet. It's not really doing you any good because you're not crashing. It's not until you crash. The problem is you don't know when you're going to crash. That's why you wear the helmet. So you do have to manage your risk. I mean, it reminded me very much of the time when I was sitting on the San Diego City Council and the fire chief and the police chief were in front of us, and they were telling us how much money is wasted on false alarms, if you will, when someone calls and you get there 30% of the time, it's nothing. And one of my colleagues said, well, why don't we just not send it when it's not a false alarm? Only when the real alarms. Of course, they said, well, we don't know when that is. And why do I say that? We don't know when there's going to be a crisis. That's why we do stress tests. That's why we want them to be prepared. That's why we don't want another 2008, because we don't know when the crash is going to happen. I mean, it seems fair to say, wouldn't you, that you have to be somewhat prepared. That's why you wear a helmet.
So loving the analogy. The reason you wear a helmet when you ride a motorcycle is because there is a higher risk of a crash. I'd analogize that to holding subprime mortgages. You don't wear a helmet when you go to bed, and I'd analogize that to holding reserves at the Fed or a Treasury security. The challenge of bank regulation is to say, where on that risk spectrum are we? And how granular do we want to be in assessing those risks? What I object to is those who just simply say more capital is always better. The virtue of this proposal is that they have actually done the work, I think in contrast to the 2023 proposal, and actually gone through asset by asset and said, here's the risk. Is it more like a motorcycle ride or is it more like a good night's sleep? Okay. And again, that's one of the great virtues of the Fed stress test. It does not assume good times. It assumes times worse than the global financial crisis across every risk stripe. And banks have to not only be able to hold the amount of capital to absorb all those losses, but still be above all the Basel minimums. So that's a lot of capital.
No, I get that, I get that. So, you have to figure out the risk. Now, Ms. Rodriguez, you're rather famous. You've been quoted more today than Mr. Powell or Mr. Baer by the people up here. So you did talk about unexpected risks, though, and you enumerate a number of them. You didn't enumerate, though, private capital, which seems to be a risk, and other things. I mean, what about this continuum of risk? I mean, it seems to me that there are these risks that are unexpected.
Right. In fact, that is exactly the original definition of capital from the Basel Accord back in the 1980s, is that capital is to help banks sustain unexpected losses. And in my written testimony, I spent a lot of time writing about the tremendous increase of bank lending to non-depository financial institutions, right? Shadow banks, non-banks, all of those are synonyms. And the rise in lending to private credit has been astronomical. And we want to make sure that banks are well capitalized. In my written testimony and in the oral, I didn't ask for more capital. I just asked that there not be less capital. And it's also not about capital. Of course, banks have to be liquid. That's why banks the size of Silicon Valley Bank need the liquidity coverage ratio. That's also why you need good, talented supervisors and examiners.
Well, let me ask about that, because you were asked by my colleague and friend, Mr. Cleaver, about the CFPB, but you weren't asked directly about the staff at the Fed, because the supervisory staff at the Fed, that's one of the things that Mr. Baer talked about when he voted no, was because of the big cuts there. Could you comment about that?
Absolutely. This is something that worries me tremendously. One of the main things that I've done over the last 30 years is train bank supervisors and examiners at the Fed, FDIC, OCC, the state bank regulatory entities. These people are smart, they work hard, and when you get rid of them, you simply don't have enough people to be identifying and helping measure risks.
Okay, and lastly, Mr. Griffith, thank you so much, Mr. Griffith, for your comments here, but you got to watch out when you say Dodd-Frank did a fantastic job, because the other side may not invite you back.
Well, relatively speaking, if you look where we were before and you look where we are now, and look, we trade on every futures market globally, and I will take the U.S. post-Dodd-Frank regime over anywhere in the world.
Thank you.
Gentleman's time has expired. With that, gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Huizenga. I want to thank Chairman Hill and Ranking Member Waters for holding this hearing, and thank you to our witnesses for your time being with us today. Mr. Griffith, you note that farmers and other commercial users depend on access to enough futures clearing capacity at a reasonable cost to manage their risks. If bank capital rules were to significantly increase the cost of providing clearing, what specific risk do you see for liquidity and reliability of agricultural futures markets, and how could that ultimately affect producers and end users?
Well, I appreciate the question and your concern for the ag markets. I think the biggest concern would be that the sector isn't able to fully manage its risks. That's number one. And as bank capital goes up, their requirements go up, our access to clearing also could potentially be limited. So that leads to not only higher prices, but it leads to more risk that's pushed down the food chain. So farmers, I know we talked about we don't want banks to go under, but we also don't want farmers to have to hold unnecessary risk. And if the bank capital is overly burdensome, they're going to have to hold a lot more risk than they do today. I think the other thing that is clear would happen is if costs go up, I mean, the large commercials may be able to absorb a little bit of that, but that's going to flow down to farmers. And the margins are already very thin in the farming community, and the costs are only going to increase if we choose overly burdensome capital requirements on our banks. I think the 2026 proposal is a nice balance between the two. There's some additional safeguards, but I also think that it would be a balance that wouldn't be burdensome on the agriculture community or on farmers.
Thank you. Agree entirely. Mr. Broeksmit, for most home buyers in my district, terms like Basel III and mortgage servicing assets sound distant from their day-to-day lives. Yet those rules can determine whether they qualify for a mortgage at all. Can you explain the link between how regulators set capital charges on mortgage servicing assets and the options, pricing, and approvals that individual borrowers see when they apply for a home loan?
Yes, Mr. Rose, and thank you again for your leadership on the trigger leads legislation that just went into effect. That's materially improved the mortgage process. To your question directly, I mentioned during my oral testimony that every 25 basis point or quarter of a percentage point improvement in the value of the mortgage servicing asset, that term that borrowers don't understand necessarily, leads directly to a 25 basis point reduction in closing costs, which on a $400,000 loan is $1,000. So it's meaningful, it's real money, and the overly burdensome regulation and capital treatment on mortgage servicing assets has led banks to go from an 88% share of the servicing market in 2012 before the Basel changes to a 39% share today. So if we fix it, the borrowers will have more choices and a more competitive interest rate market.
Thank you, and certainly we all want to see that, I think it's safe to say. Mr. Broeksmit, can you explain how setting a more reasonable capital charge for warehouse credit can help ensure there is enough funding for single-family mortgages, especially when demand spikes?
Yes, independent mortgage banks do over 60% of mortgage loans in this country, but they depend on banks and the warehouse lines they provide for liquidity to fund those loans before they're sold on the secondary market. And overcharging the banks on the capital requirement means that banks at times of stress would be more likely to pull back that liquidity just at the time the market needs them to stay engaged. So normalizing that will make the system more stable and continue to support the independent mortgage bankers who make so many of the loans in this country.
And also, Mr. Broeksmit, you and your members lived through the earlier proposal, which many of us felt did not give enough weight to stakeholder concerns. As regulators work through the current notice and comment process on the revised Basel III proposal, can you talk about how a genuine opportunity for feedback can help correct those problems? And what is at stake for home buyers and communities if major capital rules move forward without fully considering that input?
Well, I'd like to commend all three of the agencies for being very approachable and for listening to the concerns. We've gone into each of them with our members, the real practitioners who tell stories about how these proposed rules affect their constituents. We found an open door, and this proposal is miles better than the one in 2023.
Certainly agree about that. Mr. Baer, I support the move in the revised Basel III. Well, never mind, we're out of time. I yield back.
Gentleman's time has expired, but I will note and remind all of our members that if you have a question for the witnesses, you are able to get that question in writing to the chair, which we will pass along to you, and then ask our witnesses to get back to us with an answer promptly. So with that, the gentleman from Illinois, Mr. Kasten, is recognized for 5 minutes.
Thank you, Mr. Chair. Thank you all for being here. I want to echo the comments Mr. Sherman made, that I was very glad to see Basel change the rules on tax equity. There was this goofy business where certain types of tax equity had different risk weighting than other types of tax equity, which I think was just a drafting error, and I'm glad it was fixed. Mr. Baer, at the risk of being greedy, I wonder what your thoughts are on a further change, because if I understand the current rule, up to 10% of the equity on your balance sheet gets a 1-to-1 risk rating. When you go over 10%, you go to higher risk weighting, which makes sense if it's sort of equity in illiquid businesses. Right. But tax equity, whether it's housing or clean energy, really looks and feels a lot more like debt from a balance sheet. And I just wonder if you'd comment, is that from a risk, and I'm all for like making sure that like we're appropriately risked, but is that 10% on all equity still appropriate when we think about the way that banks use tax equity?
I will confess I have not done the math or asked anyone to do the math on that. I share your belief that you should get the right risk weight for the risk, but I mean, as you describe it, it does feel that risk may be overstated. But I would be happy to run the numbers and come back to you on that.
I mean, there's a long and goofy conversation that because of Senate rules, it's easier for us to make changes in the tax code than to make changes in policy. But the result is that we've now had banks filling that void. And as a guy who used to be in the clean energy industry, tax equity from a company perspective, looked and felt a lot like debt.
Yes.
Right, and from a bank perspective, and that's just different, in my view, than taking a stake in a private company. Well, would welcome your thoughts offline. Ms. Valladares, moving over to you. The OCC has made a point for a long time that banks should engage in prudent risk-taking. I could find a zillion quotes on that. Should banks have chief risk officers?
Should banks have what? I couldn't hear you.
Chief risk officers.
Banks? Yes.
Yeah. Okay.
Yes.
So I thought you'd say that. When we had the hearing after SVB went down, we learned that the OCC had compelled SVB to get rid of their chief risk officer and had never communicated that to the SEC. So public markets went for 8 months without knowing that the bank didn't have a chief risk officer, during which time their balance sheet was growing and their CEO was actively selling down his equities. We had introduced legislation at the time that said if you fire your chief risk officer, you need to A, notify the public, and B, if you go for an extended period of time, we can quibble what the extent is, you should not be allowed to grow your balance sheet until that person's in place. Would you support that legislation?
Yeah, I mean, first of all, the chief risk officer is not the only person responsible for the balance sheet, right? You've got the chief accountants,
Sure.
You've got auditors, you've got a lot of people who knew that there were problems there, and the state bank regulator in California knew that there were problems. So did the FDIC. We've seen the documentation subsequently. But of course, there should be a chief risk officer.
No, and no doubt, I'm certainly not suggesting that's the only office, but
Right.
the fact that the regulators were saying you have a risk management problem and we're going to compel you to get rid of your chief risk officer, and then investors never knew, and they could raise equity against it. Like it felt to me like an easy barn door to close, and we still haven't closed the door.
Right, no, you need a chief risk officer. I do not recall that it was not public knowledge, because I remember at the time I knew that the chief risk officer was not there, and I found that extremely bizarre, and I've written about it subsequently.
Okay.
So yes, you need a CRO. Yes, I concur with you.
With the minute that's left, I wonder what your thoughts are just in general about, as risk concentrates in the system, we learned after 2008 that if risk goes out of the GSIBs and ends up in an insurance company, risk is still in the financial system, but if that's not a supervised entity, our regulators don't see it. For a brief period of time, we had a few insurance companies that were deemed systemic. That's now stopped. As we look at other changes in our economy now, we're seeing, do risks exist in private credit? Do risks exist in the insurance company? Do risks exist on equity holders' balance sheet? I think so. But the way that we regulate, the way that we inspect risk in our financial system is really only limited to the GSIBs. Any thoughts on how we could take a more robust look to make sure that those of us who are responsible for thinking about where capital buffers need to be aren't just looking at a number of banks you can count on one hand?
Right, well, first of all the banks are regulated. Certainly my friends over at community banks definitely know that they're regulated. I think a real problem, and this is where you all can have a lot of influence, is that you need the NDFIs to be regulated, the non-depository financial institutions, because the big challenge is that they're incredibly heterogeneous, and right now they are not being regulated and they are not being supervised from a risk-based perspective. So you need a regulator who's looking at their levels of credit risk and liquidity risk and all the other problems.
We're all here in the
Time
chat.
has
Welcome your
expired.
comments offline to yield back.
Gentleman's time has expired. Gentleman from Pennsylvania, Mr. Muser, is recognized for 5 minutes.
Thank you, Mr. Chairman. We thank the witnesses for being here with us today. As has been discussed for most of the late morning, a well-calibrated capital framework is one of the most important tools we have in ensuring the growth of our nation's economy and protecting small business' ability to access capital. Thanks to the terrific work of Fed Vice Chair Michelle Bowman, the newly proposed framework seeks to achieve that goal, protecting our economy while avoiding overly stringent requirements that, in the end, restrict lending and hinder growth. The revised Basel III proposal reduces burdensome capital requirements on regional community banks in support of a pro-economic growth framework that avoids the negative effects of the previous proposals that truly would have harmed access to capital for every American. So, Mr. Ghenghi, my apologies, Ghenghi, we appreciate the objective of ensuring that U.S. GSIBs remain resilient, will capitalize under the proposal. The framework as proposed, it may result in higher surcharges relative to the Basel standard. Could you elaborate on the policy considerations supporting this calibration and how you see regulators balancing the financial stability with the competitiveness globally?
Thank you for your question. I think they do so by striking, number one, striking a balance between the risk sensitivity of a standardized approach and the elimination of advanced approaches. Advanced approaches, which are based on bank models, the banking agencies, all of them will admit are more risk sensitive. But at least with you have a new standardized approach that is more risk sensitive than the current standardized approach, that more accurately measures risk. You then have to make sure that the stress testing framework, which applies to all the larger banks, not just the GSIBs, but all the larger banks, doesn't duplicate what the revised risk-based capital requirements are meant to capture, but instead only captures any incremental risk above that. If that's what the stress testing captures, and you're accurately measuring the risk of the exposures held by banks, then I think you've got the capital requirements just about right.
Great, thank you. Mr. Baer, another concern with Basel III Endgame has been its overlap with the stress tests, particularly around operational risk. How do you believe the Fed has addressed this overlap? Does operational risk remain the primary driver? And are there still areas where the proposal could be improved?
Well, hopefully, I mean, the one thing they've done is acknowledge that there is an overlap, which previously had not been acknowledged. I think Luigi described pretty well the overlap on operational risk, where that was not previously part of the standardized approach. So the Fed put it in the stress test, and now they've added it to the standardized approach, and it's being counted twice. The equally important one and vastly more complex is market risk, where somewhat similarly, the Basel 2.5 basically used a value at risk methodology to check on market risk, which basically looks at the most common occurrences but not the tail risks. The Fed, in response to that, said, you know what, we're going to run a global market shock. We're going to assume the worst of the worst. We're going to capitalize for the tail. That made sense. So Basel was, business as usual. Fed stress test was catastrophic risk. But now they are updating the Basel proposal now with what's called the Fundamental Review of the Trading Book, and that is also going into the tail. So now we're twice into the tail, as it were, and that's something that needs to be rationalized. Again, it's very helpful that they've acknowledged that. It's incredibly complicated how to rationalize those two things, but I think they're working on it.
All right, thank you. Lastly, Mr. Ghenghi, under the proposal, large banks would apply a 10% credit conversion factor to their loan commitments, while smaller banks would continue applying 0%. Can you clarify the reason behind this differentiated treatment, particularly where the underlying risk characteristics may be similar?
Well, I can explain the rationale. I may not be able to defend it as easily, but the rationale is that currently unconditionally cancelable commitments to extend credit get a 0 conversion factor, and therefore it's as if they never show up on your balance sheet and you hold no capital against it. I think the Basel Committee determined that in practice, unconditionally cancelable commitments do get drawn down because banks do agree in advance with borrowers on what the material terms are, even if they reserve the right to make a decision not to extend credit. And so I think this is just an attempt to measure that empirical evidence of conversion.
Thank you. My time has expired. I yield back, Mr. Chairman.
Gentleman's time has expired. Chair now recognizes the Congresswoman from Michigan, Ms. Tlaib, for 5 minutes.
Thank you, Mr. Chairman. You know, one of the arguments here, Ms. Valladares, is that they continue to try to make this claim that that stronger capital requirements, which really protects all of us, because I mean, as taxpayers are the ones bailing them out when they mess up and they take these risks, that it will reduce lending, that it will hurt us. I know. So in the years after 2008 financial crisis, when stronger capital requirements were implemented, as you remember, post, again, the 2008 we required more capital. What happened to the bank's profitability and lending to the real economy? What happened?
It's really incredible. I mean, the profits and the dividend payouts, the share buybacks, the growth of assets.
They did really well.
Has gone up hundreds of percentage points in the different product classes. And given that return on wealth and income, I think most Americans, including myself, would be begging to be regulated so that we could make that level of profits. Our banks are the envy of the world precisely because of good regulations.
So if banks did quite well post-2008, why are we here once again? Faced with proposals to reduce the buffer. I don't call it buffer, it's protection. It's protection that, for me, for the taxpayer, the folks, from insolvency. I mean, they still fail because they take stupid risks, really high risks and then they come here and say, oh, we didn't know. And then the CEO's over there selling off his shares. I mean, we need to look at incentives facing these executives, really, too. I mean, in the boards, for the bank manager, right now, equity is expensive and they want to have highest return on equity possible. So can you put that in plain language? Like we're talking to our moms, like in plain language, what incentive banks face to minimize capital they were required before?
Well, they shouldn't be having less capital because it hurts consumers when they run into trouble. And when banks run into trouble and their CEOs, nothing happens to them, right? White-collar crime is rampant in this country. Nothing happens to them, and yet somebody who jumps a turnstile in a subway in New York City, somebody's chasing after him or her. So that is...
It's worse, though, y'all.
I'm afraid that's your purview, but the legislators.
But it's like we bail them out. We keep bailing them out, so why not have the protection in place? Make them have more capital in place. They were fine. After 2008, we made them do it. They were fine. They make red profits. Why are they here whining and crying to my colleagues that, it's not going to reduce lending? It didn't do it before. Why would it do it now? So the other question I have, what does the historical record suggest banks will do when regulators cut capital requirements? Would you expect to see additional stock buybacks and shareholder distributions?
That's exactly what they'll do. They'll pay more dividends, so that makes shareholders happy. That's great. They'll do more share buybacks.
Right.
That pushes up their bonuses. The problem is they're not going to all of a sudden decide to lend to the farmers in Texas, and they're not going to all of a sudden going back to mortgage lending. That ship has sailed. They're not going back to mortgage lending.
Yeah, I'm really particularly worried about the context of these proposals. The Fed is slashing the number of its bank examiners. Did you know that?
That's a big problem.
While the FDIC and OCC have proposed limiting their oversight. Did you know that? At the same time, we face this tremendous uncertainty from the AI, climate-related financial risks, and private equity. Can you talk about the context in which these proposals are being made? I mean, look at the atmosphere and the structures that are being placed right now to lessen, again, protection. And the American taxpayers, the Americans, deserve to know this because we always end up fitting the bill when we don't do what is right. It's like we don't learn our lesson post-2008. I mean, we literally set it up for failure.
There's just too many risks, and you shouldn't be lessening capital. Banks are critical to our economy. They're interconnected to you and me and interconnected to small businesses. There's a lot with AI that we don't know. There's a lot of cybersecurity threats, geopolitical tensions, all of that we've discussed here. This is not the time to have this wave of deregulation.
I agree. Thank you so much, Mr. Chairman. I yield.
Gentlelady yields back. The chair now recognizes the gentlewoman from California, Mrs. Kim, for 5 minutes.
Thank you, Chairman. I want to thank all of our witnesses for joining us today. Under Biden-Harris administration, I was concerned that their proposal on Basel III would result in less access to capital for small businesses, and it will reduce mortgage lending to working families and put American banks at a competitive disadvantage. But thanks to great work of Vice Chair Bowman and other prudential regulators, I'm confident that the newly submitted Basel III proposal addresses almost all of those concerns and puts Main Street first. Mr. Broeksmit, as we work to address the affordability crisis left behind by the Biden-Harris administration, how we're lowering the current risk weights tied to multifamily housing enable more financing for rental properties?
Thank you for the question. There's an important component in the housing bill that's wending its way through the House and the Senate that would increase the statutory limit for FHA multifamily loans, which a couple members of this committee have championed. And unfortunately, via a drafting error, it would actually reduce that amount. So we're pressing for that to be fixed because we need more multifamily lending, particularly at FHA, where they focus on the more affordable units, and that would be a big help in that regard.
Noted. Following the global financial crisis, we have seen a departure of bank participation in the origination and servicing of mortgage loans. So again, Mr. Broeksmit, how much of that departure do you attribute to capital requirements that were adopted in a rush and were not based on any empirical data or analysis?
Well, contrary to the previous exchange you heard, the rules set for how much capital is devoted to an individual asset directly affect banks' behavior. Mr. Baer said that he worked at a bank. He worked at a very big bank. I worked at a regional bank that was focused on mortgage lending. And the capital allocation required to make a loan directly affects what sorts of loan you make. So we've heard a lot of concern about the previous proposal, gold plating, meaning requiring more capital than the Basel rules did for on-balance sheet loans. This rule fixes that, and it will have an impact in banks' appetites to make more mortgage loans, contrary to what you may have heard from others.
Thank you. You know, for too long, capital requirements that have a direct impact on Main Street lending have not been grounded in actual economic data. So I'm thankful that under President Trump, we have a banking regulatory agenda that is driven by actual data and analysis as regulators evaluate the potential rulemaking. But let me shift gears now. I want to focus on asset-based lending. Asset-based lending is typically secured by non-financial collateral, such as receivables and inventory. As a result, financial data shows that asset-based lending exhibits lower risk factors for loss severity as well. Mr. Baer, do you believe the lack of differentiation between asset-based lending and other secure exposures is an area that can be improved in the Basel III proposal?
Sure. I mean, lending against inventory or accounts receivable is less risk than lending unsecured in any way. Actually, interesting with the Fed in its stress test gives recognition to that. But right now, the Basel proposal does not give any recognition to that and effectively treats it as unsecured. Now, clearly, it's less security than a treasury as collateral, but it is certainly the case that it should be worth something and should get some recognition. I think the agencies are going to have to do some work to try to figure out exactly how much, and we would certainly want to help them in that. But yeah, it's something that needs to be recognized when you're trying to assess the true risk of that loan.
You know, there's a lot to like in the Basel III proposal, but this is one area where I believe small tweaks, right, will help lower costs to borrowers in the long term. Mr. Ghenghi, how do you think the availability of extensive data helped inform the Trump administration's proposed Basel III rulemaking when compared to Biden-Harris administration?
Well, I think it's very simple. The 2023 rules were proposed in July 2023, but without any data collection from the affected banking organizations. The data collection was commenced by the Federal Reserve in October of 2023 and was completed in January of 2024. So now, with respect to this proposal, the banking agencies all had the benefit of the results of that data collection.
Okay, perfect. Thank you very much. I yield back.
Gentlelady's time has expired. The chair now recognizes the ranking member of Subcommittee on Financial Institutions, Dr. Foster of Illinois, for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. Ms. Valladares, we often hear from the banking industry that operational risk is too harshly penalized and is double counted in the regulatory capital, I think, is because its role in both the direct calculations and in the stress testing. Do you agree with that assessment? And do you think it's too heavily weighted? And do you think it is being appropriately adjusted given all of the technology-related risks that are coming in?
I think it merits to look a little bit more finely at the double counting issue. I think it is important. However, we have to remember that operational risk has always been the neglected stepchild of the risks and has never really properly been taken care of. And in my view, when I work with banks, this is the biggest weakness. And there's a tremendous amount of challenges with how operational risk is identified, measured, how it's controlled, and how it's monitored. So I think we have to be careful. I don't have a problem with analyzing the double counting, see if it's really there, what can be tweaked, but I don't believe in throwing out that whole section because operational risk is very serious at banks.
Yeah, it's very hard to quantify. You know, what's the probability that you're going to have one misconfiguration of your database and have a huge security problem?
Right.
Then, yeah, in your written testimony, you indicated a list of top 10 operational risks, and it noted that for 17 consecutive years, cyber concerns have been on that list, and this year it's number 1. So, yeah, what's your take on, you know, Mythos and all of the threats there? You know, I personally have been using these coding assistants for the last several years, and the trajectory is just really amazing, including when you say, here's a piece of code, what's wrong with it? And even the older models that they let, you know, just normal congressmen have access to, if you pay them a little bit, they're pretty impressive at finding flaws in code. And now you're just seeing really frightening stories that very solid code bases have been, you know, thousands of flaws have been found in them.
Right, I mean...
So what is what's the appropriate response to that?
The appropriate response is not to lessen capital, especially when we don't know the extent of the threats. AI is moving incredibly quickly, as you stated, and it's actually it could end up being quite beneficial for banks, but it's also opened up a lot of threats. And so I think it's the wrong time to ignore that. And AI is not part of the current stress test. The cybersecurity aren't enough of the stress tests either. So that's the problem with those issues right now.
Yeah. And if you look at everything that was discussed in the famous or infamous Citrini research memo, you know, that there's the potential for very large macroeconomic level disruptions that will fall back on the business models for many companies that have historically had very good records at paying back their loans, and all of a sudden they will become not such good bets, and the market reflected that. So what's the appropriate action there?
I mean, the appropriate action is to stop firing people at the Fed, FDIC, OCC, CFPB, make sure that there's the appropriate human resources to really keep their eye on the banks. And it's very important for the banks to dedicate more resources to all the challenges that are emanating from AI and from cybersecurity. And as I've said before, the whole wave of deregulation right now is very dangerous to our banks and our financial stability.
Now, one of the big changes that everyone anticipates is the switch to agentic finance, that businesses and banks and consumers are all going to be operating through their AI agents. And this, I think, brings in a number of new risks that we may not have accounted for in our stress testing and so on. You're going to have bank runs, you know, not at the speed of internet gossip like SVB. You're going to have them at the speed of agentic gossip on Moltbook. And you may just, you know, the normal person or business will just, as a matter of, you know, they will have a personal AI financial agent. And they will be given standing orders that if you even hear a rumor that my bank's in trouble, just pull my money out, okay? And so you're going to have the possibility of bank runs that happen at a time scale that we've not seen before. And what's the appropriate reaction? You know, what should we think? How should we think about liquidity and capital rules in that light?
I think it's going, unfortunately, we're not going, these proposals, whether they end up indeed being finalized the way they are and continue this deregulation, then we're opening ourselves up to even more risk. And the Basel Committee, as well as our own regulators and legislators, need to spend a lot more time looking at what kind of regulation you need for AI, because as you correctly pointed out, you could end up having a bank run within half a second.
Sure. Well, probably a little longer, but yeah. But this is, yeah, one big part of our job is to look around the corner at coming risk.
Gentleman's time has expired.
Thank you much. Yield back.
Gentleman's time has expired. The chair now recognizes the chairman on the Subcommittee on Digital Assets, Mr. Stile from Wisconsin, for 5 minutes.
Thank you very much, Chairman Huizenga. Thank all of our witnesses for being here today. Reasonable and appropriate bank capital standards obviously play a really important role in making sure we're protecting their stability in our financial system. but you also got to get it right. We've heard some of our colleagues today talk about inadequate bank capital standards, but I think there's a really important dialogue about what happens as you turn that dial up and what would occur if you turn the dial up, in particular, beyond those that are maintained by our peer countries. That's not always the right policy, because there's real-world negative consequences as you turn that dial up. I think some of our stakeholders have pointed out, under the previous administration, you had poorly designed bank capital rules that I think were hindering our economic growth, that were restricting loans and hurt workers and hurt the U.S.'s competitiveness. And that's why I was glad to see earlier this year a rewrite of the flawed Biden proposals. And so I look forward to kind of this discussion about where we were with the Biden proposal, where we are today, and to contrast that a bit. Mr. Broeksmit, if I can start with you. Affordability, obviously front of mind for American families. Mortgage rates have come down a few ticks. They were up at 8% maybe about 2 years ago or so. They've come down. They've kind of settled in that 6 to 6.5 range. High by recent historical standards. Maybe not high by long-term historical standards, but high by recent standards, putting affordability for housing out of reach for some. Can you talk a little bit about how the shift from the flawed 2023 framework to today's framework is benefiting people that are looking to get into home ownership?
Yes, well, one of the main improvements as it relates to mortgages in this newer proposal, for which we commend the regulators, is to get rid of this gold plating I've been talking about, where the previous proposal had as much as a 40% increase in how much capital a bank would have to hold to keep a loan on its balance sheet. And that's done away with in this proposal. And this proposal has also made the capital that you need to retain for a bank on your balance sheet lower if the borrower has more equity, which makes common sense that even if you have a failure, you're not going to have a loss if you have a 60 LTV.
I had a question teed up from Mr. Baer on the gold plating side. I could let either of you speak to this. I'll stay with you just for a minute, though. As you look at this proposal, do you think we've fully removed the gold plating concerns that you have, or do you think there's more work to be done?
As it relates to mortgages on the balance sheet, we're convinced it's been removed. Mr. Baer may have another point of view.
Yeah, I just actually note sort of the central perversity here, which we haven't really gotten into, which is the notion of having higher risk weights for mortgages for banks is the idea that if we don't, they're going to make loans, they're not going to have enough capital, they're going to fail, that's going to impose losses on the deposit insurance fund. Actually, at no time in history has the deposit insurance fund actually taken taxpayer money. It's always been replenished by the banks. But the assumption is that all the banks won't be able to replenish the deposit insurance fund, and that's why we need higher capital. But the alternative is we now have a system where all of that risk is moving to government-sponsored enterprises that are explicitly guaranteed by the taxpayer. So when you step back, it's, to quote Will Ferrell, I feel like I'm taking crazy pills. So you need to certainly have an appropriate risk weight for mortgages on bank balance sheet, but you need to look at the whole picture. Part of the picture, too, is that banks are good at mortgage servicing. They like to work with customers. These are their customers, so there's an intangible benefit to that as well. And then I just want to say one thing about an earlier colloquy. Again, looking at the big picture. Banks are making more profits than they did in 2010. Every industry in America is making more profits. That's because the United States economy has grown significantly. But over that period, banks have significantly, consistently underperformed the S&P 500. They have been labeled at various points uninvestable. It's why you've seen migration of the mortgage business, a lot of the securities business. So yes, they earn profits, but you can't look at profits in isolation. You have to look at where they are competitively as they compete for investors and capital.
Mr. Baer, not only was that well said, but you threw in the Will Ferrell quote. I think there could be more of that in this committee hearing room that are fitting. Maybe I'll just let you summarize while we're on you for a second. What do you think, if you said there's one key improvement out of the 2026 proposal that you had to put your finger on, what would it be?
It's the challenge that the Federal Reserve will primarily face, which is they have recognized, but it's rationalizing the overlaps on operational risk and market risk. As you have a global market shock, and then you have a Basel FRTB with an expected shortfall test, and those things look very much alike. You also have heroic assumptions about illiquidity, I think out to 3 months in a lot of asset classes.
We're going to be up on time, but I appreciate your testimony. I appreciate all your testimony. Yield back.
Gentleman's time has expired. With that, the chair recognizes the gentlewoman from Georgia, Ms. Williams, for 5 minutes.
Thank you, Mr. Chairman, and I thank Chairman Hill and Ranking Member Waters for holding this hearing today and for our witnesses for providing your expertise, because I have people at home that have questions and they deserve answers. If you're a home buyer in Atlanta, bank capital standards may not sound like something that affects your life, but surprise, they do. So I am here to get answers for my constituents. Bank capital is simply the financial cushion that banks are required to keep on hand so that they can weather hard times and keep lending. Last month, the Federal Reserve released proposals to modernize the capital framework for banks. The proposals would adjust how much of the cushion banks are required to hold, which will affect whether your bank will possibly give you a mortgage. Over the past decade, mortgage lending has shifted away from banks and towards non-bank lenders, as some of our witnesses just described. And they don't necessarily face the same level of oversight. Vice Chair for Supervision Michelle Bowman has argued that revisiting these capital rules is about getting banks back into the mortgage business. Getting more Atlanta families into homes is exactly my goal. More competition would mean better rates and options for buyers. But Federal Reserve Governor Lisa Cook, a fellow Georgian, has also been very clear that if we get this wrong, families, my constituents, they'll pay the price. The balance that I'm trying to understand today is exactly that. How do we strike that balance between the banks, my constituents, who are always my priority? Mr. Broeksmit, according to a recent report, Atlanta ranks among the top 5 U.S. cities for first-time home buyers in 2026. And Vice Chair Bowman says this proposal will increase mortgage servicing and origination for banks through reduced capital requirements, which in theory would help more first-time home buyers. In plain terms, very plain terms, how does this capital rule change actually translate into more families getting mortgage loans?
Thank you for the question, Ms. Williams. My son is a proud new Atlanta homeowner as of last week.
I'm proud to be his congresswoman.
Yeah, absolutely. And in plain terms, the less capital a bank has to hold against a safe asset like a mortgage, the more mortgages they can make and the lower the rate will be on those mortgages.
Okay, that was simple enough. Ms. Valladares, you stated in your testimony that there is little evidence these proposals would increase bank lending and that strong capital rules are what protect working families. Also my goal, protecting working families. Help my constituents understand if these rules aren't actually getting families into homes, what are they doing?
There's a lot of things that the Basel III was designed, and in order to help first-time home buyers or others, there's a lot of other things that have to improve. So the Fair Lending Act and other laws that obviously are your purview. Now, what Mr. Broeksmit said is correct if and only if the banks actually decide to lend and go back into that business of mortgage borrowing. And in my written testimony, I have about 10 or 12 citations of various academics, lawyers, and including the head of the Mortgage Bankers Association, who say this isn't happening because the banks started leaving over 15 years ago. And so the strategies of banks have changed, the technology has changed. So there is zero evidence that these banks all of a sudden are going to come back to mortgage lending when they have indeed been increasing their lending to private equity, to hedge funds, and to lots of other counterparties where it is more profitable.
May I respond to that since she misquoted?
Well, I do have a follow-up for her to dig more into this. But if banks are receiving more capacity to lend under these proposals, what's stopping them from returning that capital to shareholders instead of putting it to work in communities like Atlanta? And then if you want to give a follow-up to her follow-up.
Sure. I was quoting him from Politico, where he was quoted, but banks are not required to lend to mortgages. They can make choices as to where they want to lend. So I think that's also important to remember.
This is the lack of requirement that you...
Right, so no one makes the banks go into the mortgages.
Just because the rules were changed to the detriment of banks' interest in the mortgage business 12 years ago does not mean they shouldn't be changed to make them equitable. And what I said was there would not be a sea change. I've quoted several times, 88% to 39%. Well, every bank that makes another loan tomorrow because of this rule is more banks being involved. Will every bank get right back in it and have 100% share? No, of course not. That's what I said.
Thank you all for your testimony today. And Mr. Chairman, I do have more questions for the record because I am here to serve constituents just like your son to make sure I'm getting the answers for them. And I want everyone to have access to capital so that they can buy that first-time home like your son. So, Mr. Chairman, with that, I will submit my questions for the record, and I yield back.
I was going to say, the gentlelady is reminded that she can submit those questions to the chair. We will pass those along to the panelists and appreciate their prompt attention to that. With that, the chair now recognizes the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Chairman. First, I would like to ask unanimous consent to enter into the record a letter that is addressed to Honorable Michael Bowman and Jonathan Gould. It's improving housing affordability through bank capital modernization.
Without objection, other than the fact that it's Michelle Bowman.
Oh, Michelle, I apologize.
Without objection.
Mr. Chairman, I have in my hand February 20 joint letter from key mortgage and banking trade associations, which I just entered into the record, highlighting the important opportunity that exists with the modernization of bank capital standards to strengthen both financial stability and housing affordability by supporting a diverse, competitive mortgage market. Without objection, I'd like to ask that not only this be entered into the record, but also turn to Mr. Broeksmit. The MBA has argued in favor of more clarity on the treatment of private credit enhancement, both private mortgage insurance and CRT and bank capital rules. Could you please elaborate? I know you spoke about this earlier when I was here, on how providing this clarity can help improve just overall, once again, housing affordability because it's such a major issue before the House of Representatives.
Sure, and particularly as it relates to private mortgage insurance, if you put 10% down on a mortgage, you get 30% private mortgage insurance. That takes the risk of the bank from 90% to 67.5%. As written, this rule would make you hold capital as if your risk were 90% and you didn't have any first loss protection. So we recommend that they do include some consideration for the effective loan to value after the mortgage insurance, because it's good to bring in loss absorbing private capital that would absorb the loss before the bank. And on credit risk transfers more broadly, that's often used by the GSEs and larger financial institutions. Similarly, we support well-capitalized transactions like that to provide loss-absorbing capital to the banking system.
Thank you. Chair, I'd just like to note, I think of the last 2.5 hours, what you just said is the most important thing and should be the most important thing to members of the House of Representatives that are trying to figure out how to tackle the housing issue. And I have the chairman of the subcommittee sitting right to my left, so maybe he'll follow up on that. To Mr. Griffith, how do the revised capital proposals, particularly changes to risk weight and the treatment of trading activities, improve banks' ability to provide hedging and risk management services to producers, farmers, and maybe commercial end users?
I appreciate the question. So the majority of the risk in the futures market, or the primary tool we use is, the primary tool we use is the futures market. The majority of that risk has to flow through an FCM. And a lot of that sits with big bank FCMs. And if you increase the capital there, two things are going to happen. One, their ability to clear could go down. You could have people leave the industry, which definitely injects risk into the system. I think that's worst case. Best case is that the costs go up. If the costs go up, that's clearly going to move down to the merchants, and that's going to flow down to the producers. It's going to flow down to the end users, and ultimately flow down to the American consumer.
Very good, thank you. Mr. Baer, I just have a minute here. One concern has been addressed again a couple times. One of the concerns with 2023 Basel proposal was the lack of, I guess, appropriate tailoring, might be the way to describe it. How do the revised proposals better account for the difference in size, complexity, and business models across?
Sure. For the smallest banks, separate from this proposal, there's been a lowering of the community bank leverage ratio that community banks can opt into. There's a legacy standardized that would apply, that does not apply to GSIBs, but could apply to all other banks, and they have reduced some of the risk weights there. And then any bank will also have the option to opt into the expanded risk-based approach and get those better risk weights. But I would note there was another tailoring issue that's not at issue here, but which is very important, which is, in the years after the global financial crisis, there were various thresholds set for heightened supervision. There are probably more than a dozen of them. I have a chart. Those need to be indexed for GDP growth. I think the agencies probably are on a path to doing that. They've had a lot of work to do recently, but it is really important for mid-sized regional banks that they not be continued to be treated like banks much larger than them, simply because the economy's grown and they've grown along with it.
Thank you. Chairman, I yield back. Thank you.
Gentleman yields back. Chair recognizes the chair of our Subcommittee on Housing and Insurance, Mr. Flood of Nebraska for 5 minutes.
Thank you, Chairman. I'm pleased to see that prudential regulators have acted quickly to provide some certainty around the newest Basel capital requirements. It's a welcome change from when I arrived in Congress and everyone was upset with what the Biden administration was doing. And I've heard repeatedly from industry that we need a resolution on this matter so we can put it to bed and end the uncertainty. Mr. Broeksmit, can you explain the importance of removing the cap on mortgage servicing assets as assessed towards capital in the proposed rulemaking? What kinds of effects do you expect this change to have on mortgage lending? I think we might have talked about this already, but...
Yeah, but the cap specifically, I haven't covered much, so thank you for the question. The cap prevents banks that are good at and like to service mortgages from growing above a certain amount of their equity. And removing the cap will remove that constraint. We have member companies who have to sell servicing. They don't want to, have to sell servicing every quarter to stay below the cap, lest they have to hold dollar-for-dollar capital against the excess. So good banks who like to do it and are good at it will no longer be forced to sell.
I have one of those servicers in my district, Westgate Bank. They're good at it. They know what they're doing. They built a business and a great reputation on it, so I appreciate that. Continuing this line of questioning, Mr. Broeksmit, I've long been interested in making it easier for banks to get back into the business of mortgage lending. Do you think the change in the treatment of the mortgage servicing assets will make it more likely that banks originate and retain the servicing on mortgages?
Yes, I do. I'll again cite my statistics that when the mortgage servicing asset had 100% risk weight in 2012, banks serviced 88% of mortgages. Today, they service 39% of mortgages. That doesn't mean that banks that totally got out are coming back in tomorrow, but it does mean more banks will originate and retain the servicing when this punitive capital treatment is eliminated.
And what I think is important about this, just from a state that has a lot of community banks, you go down the street to your local bank, you get your mortgage, they sell it off to the GSEs. You go get your farm loan, it's backed by the FSA. You go get your business loan, you're going through the SBA. We need banks to be banks to be banks, to be that decider of how to spread the capital out. Mr. Baer, among your member institutions, do you think the capital changes proposed by Basel will significantly change their approach to mortgage lending? And if not, what could change their view on mortgage lending?
I completely agree with my fellow witnesses' comments. I was going to say Broeksmit. It's been amazing how many different ways his name has been pronounced today. But yes, I would echo everything he has said between the mortgage servicing assets and giving acknowledgement to loan-to-value ratios for purposes of the risk weight for the loan. I think there is a hope that banks will be able to keep more loans on balance sheet and then service them as well. So big hopes.
Any timeline? How long is it going to take banks to kind of get confident with this?
Well, so, as I was saying earlier, banks don't adjust immediately. You have to do multi-year plans. You have to incorporate into those plans what the capital requirements will be. It's actually one of the, I think, the underappreciated benefits of this proposal, I should say all three proposals, which is, it's been almost a decade since the Basel Accord in 2017, and there will be a benefit to banks with investors simply that there will be finality and certainty. And so that means not only that investors, I think, will look more kindly on banks, But if you're at a bank trying to do capital planning, decide whether to get back into mortgages, you're going to know that for quite a while now what the risk weights are going to be and be more willing to do that.
Thank you all very much for your testimony. With that, I yield back.
If the gentleman doesn't mind, if he would yield.
I would yield to the chairman.
Thank you. I've been sitting here trying to figure out if I would ever get a time to inject this. When I graduated with my oh-so-employable political science degree, I can always tell the poli-sci majors who are watching, I went into real estate full-time. Family's been in construction for a very long time, and this was in the early and mid-'90s to the late '90s. And that was that period of time that you were talking about where we were starting to see rapid change from banks holding those mortgages and really seeing local banks servicing their customers, and the system just started to flip. And by the time we were developing in the early 2000s, it had radically changed. And I'm just, for one, am glad that we are trying to restore that stability. Nothing against those others that are involved in the process, but this is an important cornerstone. So with that, the gentleman's time has expired, and he yields back. With that, the gentleman from Texas, Mr. Green, is recognized for 5
Thank you, Mr. Chairman. I ask unanimous consent that I be allowed to submit questions for the record.
Without objection, so moved.
Thank you.
And the gentleman yields back. With that, the chair recognizes the gentleman from California, Mr. Liccardo, for 5 minutes.
Thank you, Mr. Chair, and thank you to all the witnesses who've taken their time to be here, including those who paid their own way on Amtrak. I wanted to ask Mr. Baer and Mr. Broeksmit, and please forgive me, could you end the mystery and pronounce your last name for us?
Broeksmit.
Broeksmit, thank you. Thank you, Mr. Broeksmit. My apologies for what we've done to slaughter your name. I guess maybe I'll start with you, since you know a little bit about this business. The whole point of recalibrating the regulatory treatment of mortgage service assets, it would seem to be to get banks back in the game of mortgage lending. Is that fair to say?
Let's just say level the playing field so that those who are good at it and want to be in it can be in it without being punished.
Fair enough. And with these notices of proposed rulemaking, we're seeing estimates of tens of billions of dollars that could get back out into mortgage lending from banks. Is that fair to say?
I haven't seen quantification of it, but as I've said before, there are many banks that would do more.
Okay. Given what we've seen, and I know there's been a lot written and said about the largest banks in the first quarter of this year have returned $46 billion to shareholders, either through dividends or through stock repurchases, more than $500 million a day. I'm looking at Mr. Rodriguez's proposal, and I guess the question I ask, well, first, wouldn't substantial return on the order of $46 billion in a quarter, wouldn't that reduce the amount of funds that banks would have available for lending?
Well, I think I'll defer to Mr. Baer on this.
Mr. Baer, yeah, if you'd like to weigh in.
No, I'm glad you brought up the issue of share repurchases. I mean, if you're running a bank, CEO, CFO, and you have retained earnings, what you want to do is invest them in your business. That's what you get paid to do.
Sure.
You want to grow the business. That's what it's about being a banker. If you can't do that, or you don't have sufficient returns, maybe you do a little M&A, and then you pay your dividend, which shareholders really like. A share repurchase is the last resort for a banker, and I think probably for people in other industries. It's basically an admission that we can't earn enough on this money that our shareholders will be happy with that rate of return. And so what we're going to do is we're going to give it back to the shareholders and let them invest it somewhere else. That's never a first option. That's in some ways almost an admission of defeat. So one of the hopes out of this proposal is that to the extent that you're lowering the cost of capital, you're able to increase return on equity for banks. And that will incentivize them to reinvest that money in the business as opposed to giving it back to their shareholders to invest in some other business.
And I don't disagree with the principles you've described, but shouldn't that make us seriously consider proposals like Ms. Rodriguez's, that if we are going to loosen or accommodate regulatory requirements on banks to enable greater mortgage lending, shouldn't those also be accompanied in those cases where banks are beneath prudent thresholds for capital requirements? Shouldn't we also impose restrictions on share repurchases and dividends?
Well, I mean, if banks are beneath their thresholds, including the requirements of the stress test, they're automatically restricted from making repurchases and distributions.
Well, I think Ms. Rodriguez is saying a bit more. Would you like to weigh in?
Thanks. When I ran a stress test using global financial crisis numbers and qualitative assumptions and applied it to the NPRs, a number of these banks would barely be at the minimum, right? And that's not even including possibilities of problems with AI or other issues that we've discussed, and that's what concerns me. So no, banks should not be increasing their dividends or doing share buybacks. They should be deploying that to actually lending, which they claim they're gonna do and often don't. And it could also go for retained earnings, which you mentioned, which is higher quality capital. So I think that's very, very important to remember, because banks are not just any kind of company. They are very special because of their interconnections to the broader economy.
I mean, just to be clear, I mean, I think she's referring to her own personal stress test that she's conducted. The Fed has hundreds of people doing their stress tests. The banks have thousands, perhaps tens of thousands of people running their stress scenarios. I'd bet on them in terms of an accurate view of capital adequacy.
Thank you. I'll yield. I'll perhaps ask for information offline. Thank you very much.
Yes, and again, reminded that all members are able to submit questions for the panel through the chair, and we will pass those along. With that, the chair recognizes the Congresswoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you, Mr. Chair. I'll state the obvious to everyone, apparently, but the Trump administration. We're in an affordability crisis, and while minority-owned small businesses in Massachusetts generated $2.5 billion in revenue in 2023, many of these small businesses, our minority-owned small businesses, remain underserved by our financial system. Talking about, their ability to access equitably loans, credit, and other supports from our financial system. In fact, I know many experienced a disparate impact from the pandemic and never recovered. I represent the Massachusetts 7th Congressional District, and more recently, we have seen a number of our minority-owned small businesses close to or forced to shutter their doors, having never recovered from the pandemic. A legacy business, Final Touch Boutique in Roxbury, is one of those such businesses. Mr. Baer, during the pandemic, do you know how small minority-owned businesses were impacted compared to other businesses? Can you speak to that?
I mean, Congresswoman, I don't have statistics on that. I presume, and I think as you suggested, that they did worse, probably because they had less capital built up and were less resilient and were smaller, and that was a tough thing to be, even with PPP aid and things like that.
Fair enough. Well, in fact, one Federal Reserve research paper found that Black-owned businesses went out of business at twice the rate of white-owned businesses and saw cash decline at 9 times the level. Mr. Baer, when bank capital requirements are lowered, like under Trump's Basel III proposals, do you have data on how much of that extra money actually goes back into communities for local small business loans?
Well, I mean, it's difficult to predict as the rules are not final, so we would have to wait a year or two and see what the results are. So I can't give you any kind of accurate estimate on how much that would increase any type of lending, whether that's mortgage or securities intermediation or loans to small minority businesses.
Well, some of what I've found is that large banks are not necessarily reinvesting these dollars into underserved communities or lending more if they don't have to. So in fact, much of the research, what it bears out is that increasing bank capital requirements can actually increase bank lending and resilience. And in 2023, we saw what the SVB bank collapse almost did to small businesses in districts like mine, the MA 7th, and around the country. So we need banks that lend more, but also protect people's money. Ms. Valladares, would rolling back bank capital requirements through these proposals help or hurt small minority-owned businesses?
I think unfortunately the data and the history would show that it's very much likely to hurt them. If you see what happened during the financial crisis, about 50% of Hispanic Americans lost jobs and suffered, about 25% African Americans suffered, and about 10% of the white population suffered. Not only are there issues with discrimination, but as one of my fellow panelists described, yeah, there's issues with their access to capital, with their experience in taking out loans, all of the, these are complex issues. So there's a lot of things, and especially under this administration, I personally see no signs that there would be focus on helping underserved communities. None whatsoever.
Thank you. And in fact, these businesses are, vital to the ecosystem of our communities, social and economic anchors, and they provide mobility as well. They provide jobs and services that meet local needs and help keep our city strong in times of economic downturn. That's why I introduced the Spark Act, along with Senator Markey and others, to ensure that small businesses are invested in and supported through grants and business loans. If Republicans were really serious about improving Main Street and economic growth, they would protect people's money and pass bills that invest dollars directly into the community. That is actually a policy choice we can make right now and improve the lives of the American people. And I just want to say to my constituents, while some may have forgotten how the 2008 global financial crisis impacted you, or how the COVID-19 pandemic and SVB bank collapse impacted you, or even how the history of slavery and racial discrimination have continued to impact you, I want you to know that your Congresswoman has not forgotten you and will not stop fighting to make sure we repair past harm and prevent future harm to our businesses, communities, and families. I yield back.
Gentlelady yields back. The chair recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Well, thank you, Mr. Chairman, and thank you, sorry to make you look sideways like that. Thank you to the witnesses for being here. I just want to start out by saying I'm really happy to see the bank regulators under the Trump administration propose a new Basel III rule that actually reflects the realities of banks of all sizes, all banks of, that operate in that. But I'm going to start with Mr. Baer here. And it seems that the original 2003 proposal operated under the assumption the banks were substantially undercapitalized. So do you believe that banks in the United States are undercapitalized?
Well, I mean, actually, the 2023 proposal made no findings about that at all. I mean, that was one of the concerning things about it. It really had no data or analysis to support any of the risk weights it imposed. But, to your question, by every measure, and I go through this to some extent in my testimony, U.S. banks have ample capital. We've been, since 2010, we've had recessions, pandemics, all kinds of stresses, and U.S. banks continue to show extraordinary resiliency. We talked earlier about, Chair Powell in 2019 said he thought that capital was about right. It's increased significantly since then, both for the largest banks and also for regional banks. The Fed stress test is an annual health checkup. Again, replaying something worse than the global financial crisis, all the mortgage settlements after the global financial crisis, and worse shocks, I think, even the global financial crisis. And every year it shows that the nation's largest banks have sufficient capital. So in the face of all that, I think it's very difficult to contend that U.S. banks are undercapitalized. And then, of course, there's also the market check. I mean, if you look at analysts and investors, they certainly don't believe that U.S. banks are undercapitalized.
So to be painfully clear here, since the 2008 financial collapse, has there been any widespread evidence that the American banking system is not resilient?
Well, I mean, we've talked to some extent today about the Silicon Valley Bank failure, and there were some related ones. But that truly was a kind of a unicorn moment where it did not fail for credit risk, it didn't fail for market risk, it didn't fail operational risk, it didn't fail for counterparty risk, it failed for interest rate risk. It bought a bunch of mortgage-backed securities from the agencies and the treasuries, and it lost money because the Fed raised interest rates by 500 basis points. Those treasuries didn't default for credit. And also, the way I describe Silicon Valley Bank is all their depositors knew each other. They were all in the same text chain.
Right.
That's not a great thing. Now, there's no rule you're going to write about that. Raising capital doesn't help for that. That's just a failure, I think, of their own liquidity management and a failure of the examination staff that was overseeing them.
Thank you, I appreciate that. I'm going to move on to Mr. Broeksmit. The original Basel proposal would have broadly raised capital requirements for banks with $100 billion in assets or more. We've already discussed at length what effects that would have had on the availability of credit and opportunity for growth. So my question is, what downstream effects would this proposal have done or have had on some of the smallest banks in the United States, particular in very rural states like in Montana?
Well, as I've said before, Mr. Downing, the appetite of banks, very much including small banks, to make mortgages is diminished when they are hit with punitive capital charges for those mortgages. Another thing I would note is that for smaller banks, the cost of compliance with all of the regulatory edicts that exist in this business, and when for good intentions they're put on, somebody puts on another one, nobody goes back and looks at whether the last one is still required. So we really welcome this executive order from the president to take a holistic look at this because it crushes small banks as well as other participants in the system.
Right, with the impacts on rural financial institutions, what do you believe is the potential impact on housing affordability?
I think put most simply, fewer choices of lenders means less competition and higher prices for lending.
Thank you. As a former commissioner of insurance for the state of Montana, I was frequently frustrated by European regulatory bodies trying to force their standards on U.S. companies. So I'm going to go to Mr. Ghenghi. Do you have any concerns about how the Basel Committee on Banking Supervision operates or is structured, and is the United States treated fairly?
Well, fortunately, the Basel Committee can't actually pass laws in any country. They can set international standards, but then it's up to the national governments to implement those standards. And so in the United States, the banking agencies have taken a view that they will appropriately tailor the Basel requirements to fit the U.S. market.
Right. Yeah, I appreciate that. It was always a frustration for me dealing with those, not regulatory agencies, but on that, I've run out of time, unfortunately. So on that, Mr. Chair, I yield.
Gentleman's time has expired. With that, the chair recognizes the gentleman from Florida. Sorry, it's been a long morning. Mr. Herodopoulos for 5 minutes.
Thank you, Mr. Chairman. And first of all, I want to mention that I really like this proposal versus 2026. I think it increases both transparency and clarity. And so I'd like to ask a couple questions. I'll start with Mr. Ghenghi. In 2023 rule treated regional banks like Wall Street giants. How does the 2026 fix better tailor requirements to risk size and business model in managing that risk?
So I think the 2026 proposals basically recognize that there is a congressional mandate to tailor requirements. That is a mandate. It's not an option. And therefore, the enhanced risk-based requirement, the new standardized requirement, applies to the largest banks, the Category 1 and Category 2 institutions. And then they've proposed a revised standardized approach, which is new, which the 2023 rules did not have. But the revised standardized approach is meant to apply to smaller banks. But at the same time, to the extent that a regional bank does a side-by-side comparison and decides that there actually would be some benefit to adopting the more enhanced, more risk-sensitive approach, they have the option to do so. So it really gives banks an option to decide what level of complexity of capital requirements they want to be subject to.
Thank you. And Mr. Baer, how does this proposal keep Dodd-Frank capital floors in place while making smarter changes above them to unlock potential growth?
Right, and I just follow up with the regional banks just to add, because it hasn't really come up today because it isn't technically part of the hearing. But I think for regional banks, they are going to have good options with regard to capital, and they won't be discriminated against vis-a-vis the largest banks. But a lot of the burdens are actually supervision. the burden of examination on them when they are not systemically important. And I think that's where a lot of the agency actions around defining safety and soundness, material risks, things like that, I think are going to be really important for regionals. It's also why, as I noted a few minutes ago, why tailoring is going to be really important. You know, it is the case. I mean, this proposal, although some try to lampoon it as something else, is very consistent with the Basel approach. In fact, it cues more closely to Basel than the 2023 proposal did. And so, you know, it's very much in the mainstream of what was intended by Dodd-Frank and the Basel Committee. And it really sets the U.S. up, again, with a predictable, sensible, risk-sensitive approach, whether you're a GSIB, a regional bank. And again, the smallest banks have the option of just simply doing a leverage ratio because their balance sheets are not terribly complex, and they've received relief on that. So I do think, you know, regardless of where you are on the complexity spectrum, you're going to see some sensible capital relief here that will incentivize you to make smart loans.
Well, I think in general, Mr. Chairman, I think the focus needs to be on that certainty and stability that you're trying to offer banks, given flexibility that fits their model best, because the goal is to make access to capital less expensive. And when the banks are given that option, I think they're going to meet those customer needs. The last question I'll ask Mr. Baer, and if others want to pipe in as well, would be great. I think the 2023 issue lacked clarity, as I mentioned before. How does this new proposal actually increase transparency as well? I think that's one of the things that people want to see from the banking industry is that transparency. It's one of the things I've been pushing for in budget matters. But how does this issue on really elevate the transparency angle versus 2023?
Right. So, I mean, I think when it comes to Basel and the GSIB surcharge, it's status quo. I mean, the big change has been on the Federal Reserve stress test, where the scenarios were never put out for comment and where the models were secret. The Fed, I think, has done an exemplary job. It took a lot of work, but they have now published both a scenario design guide. They will be publishing scenarios every year for public comment, not just bank public comment, but anybody's public comment, academics, and then the models are now public as well. I think as a result of their being public and being subject to comment, they are going to get much more accurate and much better. Again, the remaining changes, particularly around market risk, where the models are fantastically complicated, it will be a matter of reconciling those with what's in the standardized approach for market risk in the Basel proposal. But again, it is an underrated virtue of this set of proposals that the U.S., and I would say in quite significant contrast to Europe, is going to be a place where people who invest in banks know what the rules are going to be, whereas I think European banks lumber under a series of sort of secret capital charges that they call Pillar 2.
And I would just say, Mr. Chairman, I think this is one of the keys to take the mystery out of banking, and there's no better way than to have this type of clarity and transparency to take some of that mystery away. And with that, Mr. Chairman, I yield back.
Gentlemen's time has expired. I'd like to thank all the witnesses for their testimony today. Without objection, all members will have 5 legislative days to submit additional written questions for the witnesses to the chair. Questions will be forwarded to the witnesses for your response. We kindly ask that you reply by June 2, 2026. And with that, thank you again, and this hearing is adjourned.